Even if we had a great idea for a treatment, there's no way to test whether it's effective or not. So that's the enormous advance that we'll get if we can develop a biomarker for this disease.
In Boston, Ann Mostu, Bloomberg News.
Wine is a $300 billion global industry where one person's opinion can make fortunes or break them. That's because of this man, Robert Parker, and his newsletter, The Wine Advocate. For 3 decades, he dominated as the world's most influential wine critic. Now Parker's protege is building an empire of his own. Antonio Galloni runs Venice. Antonio, tell me, what are you trying to build at Venice?
Well, at Venice, we started with the idea in 2013 of building a world-class platform. We have a database of about 250,000 professionally written reviews. On Delectable, we have 7 million user reviews. Through Delectable, we also have a partnership with Whole Foods and several other partnerships that we can't announce just yet. And when you put that all together, what we have is something that no other company in our space can even come close to.
Do you think of yourself as the next Parker?
Not at all.
Why?
Because Steve Jobs said you can't live your life trying to be somebody else. So he's one of my biggest influences, and I've never wanted to be a replica of somebody else because a replica is never as good as the original. Bob is a genius, fantastic, one of a kind. We're going to be something completely different, and I have no desire to be some version of somebody else.
Different in what way?
Every decision that I've made at this company is completely anathemic to what Bob did with his company. I want our writers to be partners. All of my senior people are locked into the company. They all have equity or they have a path to equity based on business results. That's something that we never had at Parker. Our benefits are world-class, and everything that we've done at Venice is completely different from that model. When Steve Tanzer, who is the most experienced active wine critic in America, wants to work with us, that says something. When Alessandro Masnaghetti, who's the best cartographer of vineyards, wants to work with us, that says something. When Neil Martin, who's a superstar wine critic, with enormous experience in Bordeaux and Burgundy, and the former lead critic at The Advocate wants to come and be part of our team. That says something.
You make it sound like the Wine Advocate was a disaster as a company and a miserable experience as an employee.
No, it was great because I got to work with Bob Parker when he was at his prime, you know, and Bob was like a second father to me, and we talked on the phone all the time, and he gave me great advice.
Can anyone's palate dominate the wine criticism business the way Parker's did? And should anyone's palate dominate it the way his did?
I just think the world is very different today. You know, I mean, it's just a totally different world. It's probably not healthy to have a single person dominating the world.
It's not even wine criticism, it's the wine industry.
Yeah, that's probably not the healthiest thing in the world. But I think that there's just such an opportunity right now with social media and technology to reach such a massive number of people that I think it's possible that one or two people will actually have more influence than Bob Parker did, because they will, again, this goes back to your first question, not trying to be a version of somebody else. You see this in sports all the time. It's like, oh, well, nobody will ever beat this record. And then somebody comes along, you know, it's like tennis, Pete Sampras. Nobody's ever going to win as many Grand Slams. Now you have two guys who are ahead of that and one knocking on the door. And so I think a lot like that.
You're a former investment banker. How does that inform and influence what you're doing and what you've done?
My generation has had to deal with a lot more challenges. That's why I think we're actually much better poised for the future. My first job in finance, the first thing that happened was long-term capital, 1998. Then the tech bubble melted down. Then there was a mutual fund trading scandal. You know, that was all like within about 5 or 6 years. And these are the things that I had to deal with as a young executive. My peers who were 20 years older didn't know how to manage in crisis. They'd only seen Black Monday. They'd just been in a big bull market. It's very different. So I'm very lucky. People of my generation or a little bit younger have actually had to deal with a lot more crises. I think that's actually good for learning how to cope with challenges in business.
From the outside, it kind of looks like you're trying to demolish the house that Parker built, right? You left the Wine Advocate.
Yeah.
You merged with one of his chief rivals.
Yeah.
And you just hired his successor, Neil Martin.
Mm-hmm.
So are you?
I think what that says is that all the best people want to work at our company, and that's really what we strive to create starting in 2013. We wanted to create a world-class company that would attract the best-in-class talent, and not just on the content side, on the technology side, on the digital side, our office, and at every level, what we're trying to, we only hire superstars, and we're looking for those superstars.
In the world of professional wrestling, there's something called a swerve.
Hulk Hogan has betrayed WCW.
Some examples. These tag team partners are called babyfaces, or the good guys. Then one of them swerves when he super kicks his tag team partner in the head, quickly assuming the role of the bad guy, or what the wrestling world calls the heel.
Are you kidding? What a despicable act that was!
Or a match is almost lost when, what's that? It was no surprise that World Wrestling Entertainment, known as the WWE, the most popular brand of sports entertainment in the world, is prepared for any swerves that come their way. So here's the story of how the WWE learned to see the swerve coming. So I spoke to Bloomberg reporters Felix Gillette.
I'm a writer for Bloomberg News for the global business team.
And Kim Basine.
And I'm the U.S. luxury reporter at Bloomberg.
To find out exactly how the WWE is positioning itself for an all-out global invasion, which starts with a massive change to their lucrative pay-per-view model.
WWE basically pioneered the pay-per-view model on cable. I remember as a kid, when the pay-per-view events came up, all of our friends would scramble around and try and get one of the parents to pay for it.
But in 2014, they took a huge risk.
They saw a little bit sooner than some of the other entertainment brands that where this whole thing was moving was away from cable and satellite television and towards on-demand streaming video apps. They made this risky decision, in essence, cannibalizing that pay-per-view model, which they had essentially built.
And after some early turbulence, it's working. Roughly 1.5 million people are paying $9.99 a month for the WWE app, making it the 5th most popular streaming OTT service. This adapt-or-die approach is in the WWE's DNA. Over the past 30 years, the company always seems to think 2 steps ahead. In the early 90s,
WWE was at its most threatened when Ted Turner took them on with WCW,
which stands for World Championship Wrestling. And back then, the WCW was winning the ratings war. So in order to compete with them,
WWE had changed its product from a family-friendly kind of cartoonish style to this really raw. That's why they called their show Raw. It was this raw style of wrestling.
With violent, outrageous, reality-inspired plot lines and aggressive personas.
From a 16-foot ladder!
And they won that fight against Ted Turner. And they bought WCW.
The early 2000s ushered in an era of testosterone-driven programming aimed at the red-blooded American male.
Bra and panties matches, and people smash each other over their head with like barbed wire bats and things like that.
Until 2015, when WWE fans started a hashtag Give Divas a Chance. Since then, WWE has hired 40 more female wrestlers, and that growing cast of female characters was part of a much larger plan.
They started to try to appeal to a broader set of people.
Let's attract more female fans. And after we've attracted more female fans, let's attract more international fans. They're broadening their base, and they're doing that in large part to make it more advertising friendly.
And not just friendly to advertisers.
They're trying to build up their fan base in China. They're trying to build up their fan base in Europe. They, already have a pretty good fan base in India.
India is a place where they already have an established wrestling culture.
Because of the gigantic Indian wrestler, the Great Khali. But there's still a lot of work to do. While the WWE set a revenue record in 2017, only 30% of it is coming from an overseas audience. And there's one person whose responsibility is to grow that number.
The buck eventually stops at Vince McMahon, no matter what's happening within WWE.
Yeah, he's a very controlling guy, and it's a very, very, very tightly scripted company.
And that goes all the way down the board to the big stars' entrance music. And their outfits and things like that.
So with a CEO like McMahon always planning 2 moves ahead and an aggressive push into multiple international markets, a big issue is money.
It's hard to do all those things simultaneously without committing a huge amount of capital to it.
And that's where the WWE becomes an attractive company for buyers.
Potentially, one thing that could happen with WWE is they could benefit by being acquired by a bigger technology or telecom company, an Amazon or Facebook or a 21st Century Fox.
So with a market cap of $2.8 billion, the advantage of owning 100% of their own content, and a rapid consolidation spreading throughout the entertainment industry, it looks like the WWE is well positioned, even if there are swerves.
Our world is changing. Every day, it changes a little faster. Some changes are too small to see. Others, too big to handle. Sometimes, change feels slow. So slow, we don't even notice. Other times, it happens all at once, and we can't keep up. For our climate, change means many things. And between too small to see and too big to handle, there is a whole world of difference. The clock is ticking. This is Bloomberg Green.
Saving the seas. This week, the deep-sea diver who stopped writing the ocean's obituary to find a solution. Enric Sala tells us why the next 10 years matter most. And globalization needs to get greener. Shipping accounts for nearly an eighth of all transport emissions. How can the industry clean up its act? Plus, protecting coastlines comes at a huge environmental cost. But one Israeli startup found a way to keep the sea out and the animals in. From London, I'm Anne-Marie Hordern, and this is Bloomberg Green. After more than a decade of studying the ocean as an academic, Enric Sala realized he was writing the ocean's obituary. He quit his job and became a full-time conservationist. As an in-house explorer for National Geographic, he's clocked more than 5,000 open water dives. He's also founded Pristine Seas, a project that combines exploration, research, and media to lobby countries to protect their oceans. To date, it has helped create marine reserves equivalent to half the size of Canada. I spoke to him about his mission and why it's so urgent.
The state of the world's oceans is really bad. We have lost 90% of the large fish in the ocean. Sharks, groupers, cod, tuna. More than half of the fish stocks are overfished, which means that we are taking them out of the water faster than they can reproduce. More than half of the ocean is affected by industrial fishing, and global warming is killing coral reefs all around the world. The ocean is in a trajectory of decline.
Can you just visualize for our viewers who never get to see the kind of things you are able to see, what an ocean and healthy ecosystem looks like versus one that's next to a bustling economic and industrialized area?
Coral reefs in the United States, in the Florida Keys, are down to only 2% of what they used to be. Before, 80 to 90% of the bottom on a coral reef in the Caribbean was covered by live coral. Now, Florida Keys have only 2%. The average in the Caribbean is about 5% of the bottom covered by live coral. The rest is covered by slime and seaweed. And most of the fish you can see are this big. And it is very, very rare that if you jump into any place in the Caribbean at random, you see a shark. It's very, very rare. Now, let's go to Millennium Atoll, for example. An atoll that is uninhabited and fished south of the equator in the Central Pacific, belongs to the Republic of Kiribati. 2009, we conducted the first underwater expedition to this island, and I still remember the first time. Jumped over the side of the boat, and as soon as the bubbles cleared, I was surrounded by 15 gray reef sharks. After a couple minutes, the sharks decided that we were boring, and they went back to do their thing. And you look down, 90% of the seafloor is covered by thriving coral, and it's full of fish, and a sea turtle comes by. Now, this abundance that we rarely see anywhere except in well-managed marine reserves. This is what the ocean used to be like, and this is what we have learned from going to these pristine places.
And you write in your book that you're writing the obituary of ocean life. What's the cure?
The cure is doing less harm. Basically, there are three things that we are doing to the ocean. One is we are taking fish out of the water faster than they can reproduce. Two, we are turning the ocean warmer and more acidic because of man-made climate change. And three, we are throwing in everything that we don't want, our waste and our plastic. We need basically to reverse these trends.
Does this mean that a lot of this falls to governments and their policies?
That's a big part of it, because it is governments that regulate fishing and mineral extraction and oil extraction. It is governments that have the legal authority to create large marine reserves in the ocean. But also, local communities have an important role to play because some of the most successful protected areas in the ocean are community-led and community-managed marine reserves. So when the fish come back, the divers come in. And that creates huge economic opportunities through ecotourism. These areas that are managed by communities are very successful because the communities have a vested interest in having as many fish as possible inside them so they can enjoy the benefits.
What from the pandemic has changed your view when it comes to protection of the environment?
Nature has given us a very strong signal of how fast it can recover if we just give it space. Everybody was fascinated by all these videos of the whales and the dolphins coming into marinas and mountain lions on the streets of Santiago in Chile, wild goats in the UK. Nature has this extraordinary ability to bounce back if we just give it space. This is why we need to protect at least 30% of the planet by 2030.
How do healthy marine ecosystems help in the fight against climate change, though?
Most people see the ocean as a victim of climate change, but the ocean can also be a solution because we know that the more life there is in the ocean, like big fish and big whales, the more these organisms help to make the ocean productive and absorb more CO2. The kelp forest, seagrass beds, all of these are important ecosystems in the ocean that are similar to the forests on the land that capture a lot of our carbon pollutions.
What are you most excited about in your field?
We have 10 years to fix this problem. Global fisheries catch is going down, stocks are collapsing. Business as usual means that by 2050, 90% of the coral reefs are gone, that most commercial fisheries have collapsed. That affects food security, that affects a migration of people. We have 10 years to get to peak greenhouse gas emissions and then go carbon neutral by 2050. And we have 10 years to protect at least 30% of the ocean so we can restore much of this health and productivity, not just for saving biodiversity, but also saving our life support system. We are not talking about something that is apart from us. We are not apart from nature. We are a part of nature. So these 10 years are probably the most critical in the history of humanity.
The most accurate measurements of changing oceans will come from space. While Enric Sala explores what lies beneath, a new satellite is giving us data from above.
We'll learn more about our oceans and climate change, but from space. A new satellite's been launched from California. Its mission, track the accelerating rise of sea levels.
Well, the main instruments on board include a dual-frequency radar altimeter. And this is the primary instrument of the mission, and that's the one that's measuring sea surface height, significant wave height, and wind speed over the ocean. And from those measurements, we can actually have the superb measurements that we expect of sea level rise.
Data gathered from Sentinel-6 will be used alongside information from other satellites to build as complete a picture of the oceans as possible.
With a long record, we can precisely measure the acceleration. We eventually can detect new regime, tipping points. For example, if there is a runaway in the melting of Greenland or Antarctica, sea level will record this runaway change because it is an integrator of all changes that are occurring in the climate system. So we will be able to see some change, big change in the global climate.
The National Oceanic and Atmospheric Administration expects that sea level rise will increasingly threaten U.S. coastlines. One example, the southern tip of Manhattan is expected to flood 20 to 40 times a year by 2030.
11 of the 15 largest megacities are located at the coast, and this number will double. The number of people living in coastal area will double by 2060. So, knowing how much sea level is rising at the coast and how much it will rise in the future in coastal areas is as obvious. It's obviously a major goal for human beings.
Coming up, from sails to steam to oil, the shipping industry is no stranger to change. But how will it navigate the next transition? This is Bloomberg Green. From Bloomberg's European headquarters in London, I'm Anne-Marie Hordern. This is Bloomberg Green. Now, for your roundup of this week's latest climate news, Jennifer Zabazaja has your Green in Brief.
Here's the climate news you need to know. Deforestation of the world's largest rainforest has hit a 12-year high. More than 4,000 square miles of the Amazon rainforest was destroyed in 2020. That's a 9.5% increase from a year earlier. Government data shows that destruction has soared since President Jair Bolsonaro took office and weakened environmental enforcement. The Amazon is home to millions of species and plants and is critical in the fight against climate change. Bitcoin is hitting all-time highs, but at what cost to the environment? The cryptocurrency is energy intensive, and there are concerns if it becomes mainstream. According to MIT, back in 2018, Bitcoin's carbon footprint was almost as big as Portugal's. Want to get better at tackling climate change? We'll hire more women. That's according to Bloomberg New Energy Finance. Firms with 30% or more women in top jobs tend to perform better when it comes to the environment and are more likely to set clear climate goals. Shopping online is more popular than ever now, but the price of convenience is measured in CO2, and more deliveries means more fuel burned and more packaging wasted. So what can companies do? Well, many are becoming more efficient and sourcing more clean energy for their data centers and warehouses. And England's farmers will be paid to go green after Brexit. As European subsidies are phased out, they'll get new money to encourage them to produce healthy, sustainable food. Poor farming practices are one of the leading drivers of water pollution and the loss of biodiversity. I'm Jennifer Zabasaja in New York. Anne-Marie, back to you.
The shipping industry is more than just the grease on the wheels of globalization. It's its chief enabler. 11 billion tons of goods are transported by ship each year, the biggest contributors being 2 billion tons of oil, 1 billion tons of iron ore, and 350 million tons of grain. According to the International Chamber of Shipping, 80% of Europe's imports and exports happen over the seas. And for such a vast industry, it also contributes its fair share of emissions. Shipping makes up 12% of global transport energy consumption. So how does it clean up its act? Earlier, I caught up with Bloomberg Green reporter Laura Milan about just how big of a challenge this is going to be for the industry.
One of the main issues is size. So about 90% of the world's cargo is moved by ships. So obviously changing such a huge industry is not going to be fast and it's not going to be easy. The second issue has to do with technology. So ships obviously travel for many days at sea. It's not as easy for them to refuel as it would be for a car, for example, going on a road. And the sector still hasn't found a technology that's economically viable and that's zero emissions and equivalent to the electric batteries for cars, for example.
But actions are being put in place to make the industry a bit more environmentally friendly. Walk us through those steps that they're taking.
That's it. So there's a first step that would involve using low emission fuels or biofuels that would significantly reduce the existing emissions. And then at a regulatory level, when it comes to the policy and the governments, there are steps being made as well. I would say that the most significant ones come from the European Union, which started to track emissions a few years ago and is now looking to include shipping emissions in the emissions trading system. So that would significantly reduce and help calculate the emissions from the shipping industry. Now, China is taking similar steps. So at the moment, regions need to report shipping emissions to the central government. And finally, we have the International Maritime Organization with a pledge to reduce shipping emissions by 50% in 2050. Now, we must say that that pledge has been considered insufficient by environmental groups, but at least some steps are being taken.
So to get to 2050, the industry obviously is going to need to start tapping some new technologies. What new technologies are you seeing being introduced into the shipping industry?
So So we have seen pilot technologies being developed for years now, but what's interesting about this current moment is that we're seeing big players invest in these technologies that are not yet economically viable, but that one day might be. So for example, we are seeing earlier this year, the world's largest agricultural commodities trader, Cargill, saying they will invest in attaching sails to their ships so they can make any technology that they run their ships on more efficient. Similarly, we have seen a spin-off of Airbus, the aeronautics company, developing a similar application with kites. We have been following also developments in hydrogen. So at the moment, hydrogen fuel seems like a good option, a possible option when it has been developed and when it becomes economically viable. And we have Vestas, for example, the world's largest turbine maker, developing some ships that will be able to run on hydrogen in the near future.
Coming up, rising sea levels means humans need to get creative when it comes to coastal defenses. But how do we protect both ourselves and the environment? One Israeli startup may have the answer. That's coming up next. This is Bloomberg Green. In London, I'm Anne-Marie Hordern. This is Bloomberg Green. After water, what's the resource that humans use the most? It's concrete, 3 tons a year for every person on the planet. And engineers estimate it's used twice as much as all other building materials combined. And it comes with a huge environmental cost. Concrete, not just in cities, it's a common feature on our coastlines too. And that's taking a toll on biodiversity. But one Israeli startup has found a way of making sea defenses stronger and encouraging life to thrive.
If you take a look at concrete structures like breakwaters or seawalls, the water around them is often clear. That's not actually a good thing, because it means there's no life. Marine species are actually most abundant in coastal areas, but it's also where us humans prefer to live too. So when we build here, we drive away marine life.
Concrete in the marine world has a lot of additives, a lot of chemicals, and some of those materials are actually leaching out, and they're actually prohibiting marine life to thrive. If we keep developing without any regards to natural communities, there is a tilting point from which beyond we cannot really go back.
In the coastal city of Tel Aviv, an Israeli startup wants to revolutionize our urban coastlines. Their sea defenses are transforming lifeless man-made structures into teeming ecosystems. They do this by replacing standard concrete with their own special cement formulas.
As opposed to regular cement-based concrete, e-concrete includes certain elements that enhance the growth of marine flora and fauna of plants and animals. Our admix, which is kind of our secret sauce, is basically kind of sealing the concrete, making it less aggressive for the marine environment. That once we add it, we enable life to flourish.
In the lab, the team run tests to identify what mixes will work best for marine life.
So we take really ice cube sized concrete slabs of different compositions, and we put larvae, 20, 30, 50. We need to have a lot of replicates. We're geeky scientists, so we have to have a lot of replication and controls. And then within a few days or just a few weeks, we can get an answer on their preference. So obviously if they die, they have a very low tolerance to that specific concrete mix design. And if they thrive or they flourish, we can quantify that very quickly.
E-Concrete says it typically sees double the biodiversity of regular grey concrete. From fish and sea caterpillars on their armour blocks to crabs on these tidal pools that sit on the shoreline.
This unit holds water during the low tide, so it's always moist, and therefore it has a very comfortable habitat for crabs and sea anemones and sea stars, etc. These pools have been here for less than 3 months, and this is already what you can see. It's covered with life. See the rock around it, which has been here for probably 10, 20, maybe even more years, only has a thin layer of green algae, and that's it.
As well as the composition of the cement mix, E-Concrete designs its products specifically to the marine environment it will be deployed, to create niches for endangered species, or to develop nurseries like these oyster beds. The final part of the equation is creating complex surface textures to mimic natural rock or coral, an environment that helps anchor young organisms.
When concrete elements are being cast, the typical goal is to have a very slick surface, very, very smooth. The idea is to get the water to flow right across it. When we're designing E-Concrete with a rough surface, we want to do the complete opposite. We want to slow the water when they are crossing the structure so that the larvae can actually adhere and attach to the surface.
E-Concrete has to offer its clients more than just ecological credentials. Over time, they've discovered that creating hospitable habitats for marine life adds another advantage, one that is surely hard to ignore.
We've seen evidence to the fact that the growth of the organisms on the concrete create kind of a layer of defense. Just the addition of weight, we can actually gain stability and strength over time.
This is let's say the unit when we put it in the water. And this is after a year in the water. And what you can see here is all the oysters are completely covering it. We designed the units so they can withstand the forces and perform in terms of structural performance, but they can also be a backbone for ecological enhancement.
The company tests its miniature designs in tanks full of real seawater, rocks, plants, and animal life from around the world.
What we're looking for is the accumulation of calcium carbonate on the surface of the concrete of different mixes and different designs. This is the process we call biogenic buildup. So with time, we get a buildup of calcium carbonate that is sourced from marine organisms on the surface of the concrete. And we actually encapsulate the concrete with a natural rock. So when the organism die, in case of a coral, it will die, and then another coral will sit on it, and that's how a reef is growing.
The hope that our man-made structures could become stronger over time also means better economics. The units require less maintenance and could therefore stay in the water for longer. E-Concrete, though, is just a few years old, so it needs more time to really quantify the longevity of its products. But the company are certain their products are better for the environment, and not just in terms of improving biodiversity.
We're kind of trying to offset some of that immense carbon footprint of the concrete industry.
Construction is responsible for about 11% of global carbon emissions. By adding a biological crust to their products, E-Concrete prevents some CO2 from being released into the atmosphere.
For every kilogram of calcium carbonate being created by those marine organisms, we're offsetting 120 grams of CO2. So think about building a port infrastructure or a city waterfront that is an active carbon sink. I think that's a great advantage of the technology.
That does it for this week, but let's keep the conversation going on Twitter. Follow us at Climate. I'm Anne-Marie Hordern, and this is Bloomberg Green.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
It is now 2 p.m. on Wall Street, and we have the equity market sagging under the weight of a couple of key issues today. From Bloomberg World Headquarters in New York, I'm Doug Krisner. First and foremost is a lot of doubt around President Biden's economic agenda, particularly after Senator Manchin rejected this current tax and spending package. It's worth roughly $2 trillion, and it's the reason that economists at Goldman Sachs have reduced their forecast next year for U.S. economic growth. They are predicting now GDP in the States will grow at a rate of 2.9%. That's down from their earlier estimate of 3.3%. At the same time today, we've got a close eye on a spike in COVID cases, particularly in Europe, where a number of big countries are introducing more restrictions. In terms of equity market price action right now, we have in the broader market the S&P 500 down about 1.5%. It's financial along with material and industrial shares leading the slump. The Dow is off more than 1.5%, and where the NASDAQ comp is concerned, a loss right now of about 1.6%. Trading volume, to be fair, very light given the holiday shortened week, and thin markets tend to produce somewhat exaggerated price movement. We have crude oil tanking with WTI now 67.90, so we're down more than 4% in the New York session. In terms of price action among equities, we have Moderna shares right now trading lower, even though the company is saying that a third dose of its COVID vaccine increased antibody levels against the Omicron variant. And also among big pharma, Novavax shares being heavily traded. European regulators have cleared Novavax COVID vaccine. Reuters reporting that deliveries are set to begin in the first quarter of next year. And we're also seeing weakness in shares of Oracle. The company is buying the medical record system provider Cerner Corporation for more than $28 billion. Oracle shares down about 4.5%. I'm Doug Krisner, and that is your Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Live from the Interactive Broker Studio in New York, streaming on YouTube. It's Monday, December 20th, 2021. I'm Tim Stenovic. Carol Masser is off today. Joining me this afternoon is Bloomberg News cross-asset reporter and Quick Take co-anchor Katie Greifeld. Hey, Katie.
Hey, Tim. How are you doing?
I'm doing well. I'm doing a little better than U.S. equities are doing. A sea of red on the major indices. Investors trying to make sense of rising coronavirus cases. Also, the fate of President Biden's economic agenda. We are waiting to hear from Press Secretary Jen Psaki, set to speak in just about a half hour, answer reporter questions. We're going to take you live to that when she starts to speak. We'll also have more on the markets with Abigail Doolittle and Kriti Gupta in just a minute. Also on the virus, Dr. Peter Alpern from the digital platform for medical professionals, Doximity, will be joining us. And we're going to talk President Biden's first year in office. America's economy improved more in President Biden's first 12 months than any president during the past 50 years. A new column from Bloomberg Opinions, and are also by our editor-in-chief emeritus at Bloomberg News, Matt Winkler. We're going to talk to him a little later in the show. Plus, what is company culture if you don't have an office? And VC investing, what's it going to look like in 2022 after a banner 2021? We'll also get Nike and Micron Technology earnings after the bell. First up, though, let's get to the Market Drivers Report. With us now in the Bloomberg Interactive Brokers Studios is Kriti Gupta, Bloomberg Markets correspondent for Bloomberg News. Also joining us, Abigail Doolittle, Bloomberg Markets reporter. She's with us in the Bloomberg Interactive Brokers Studio as well. Kriti, I want to start with you. What's caught your eye today?
Might as well
Apart
say,
from the,
what's the stock market's problem, Tim?
I mean, that's the question, though, right? Is this Omicron related, or is this President Biden's agenda related?
I think it's honestly both, and on top of it, just kind of year-end rebalancing. I mean, you are seeing a lot of and you're going to see a lot of that because it has been a banner year for stocks. So the question here is, does that last for the rest of the month, or do you start to see a little bit of that ease up as well ahead of what should be a pretty traditional Santa rally, but maybe not this time? The Omicron variant is definitely having an impact, and you saw it really in kind of early trading, this kind of reversal to the 2020 trade, and essentially that names like Clorox Clorox, P&G, Kimberly-Clark, they were actually gaining in the pre-market. You have those travel names sinking, and then it kind of flipped on its head.
Right,
So,
that's really weird.
yeah, which tells you that there may not be a fundamental kind of reason or drive for this market the way it was perhaps at the market open at 9:30. That being said, you also have Senator Manchin's crucial support that is being lost for the Biden campaign. Remember, this was an 8-year plan that was actually being taken into account by the market, especially when it comes to commodity demand. And you saw the best example of the hit from that with Goldman Sachs' downgrade or not, I shouldn't say downgrade, I should say forecast cut is the better phrasing for that. Because it does have very real consequences for not only commodity demand, but things like bringing semiconductor usage and production here back onto U.S. soil, as well as things like work from home.
Abigail, can we talk about bonds? Because I look across equities, I look across risk assets, and maybe it's rebalancing, but maybe it's just this all-out aversion to risk. But then I look at treasuries. I see yields higher on the day. What is going on?
You know, that's a great question, Katie, because it's all about bonds, and it has been really for the last week or 2 weeks. And today is a bit puzzling in terms of this massive risk asset sell-off earlier. A little bit of a bid for bonds, but to your point now, really much ado about nothing. We have the 30-year yield up 3 basis points. We have the 10-year yield up slightly. Now, that 2-year yield down just a little bit. So investors not seeking that safety. And I would argue that if you were to take a look at a 1-year chart of the 10-year yield, the uptrend is very much in place. So even over the last week, it has felt like investors going against the hawkish Fed last week, they're already on board. That trend is higher, suggesting that you're going to continue to see bonds sell off. And if that does happen, and it is, of course, a big if, the question is, does that create some kind of pressure for stocks? I think that that's been a piece of the tech selling. And something I'd like to add in terms of the overall volatility today, let's not forget that Friday was options expiration. A lot of times the following Monday, you'll continue to see a bit of a slide in messy trading. So I think we're seeing that, and a little bit of a cleanup now, not just in stocks off the lows, but oil also off the lows.
Okay, so I want to make sure I understand this, Abigail. Are you saying that the bond market is essentially telling us that there's nothing to be concerned about?
I think the bond market is telling you that they're on board with the Fed. For a few days, it actually felt like the bond market was suggesting maybe there is something to be worried about, because here you have this hawkish Fed saying that they're going to raise rates 3 times next year, 3 times the following year. They're going to stop buying assets. And you had bonds rallying, yields going lower. So the only explanation I can come up for that is some fear around this variant and the idea that we're seeing, selective shutdowns and, some fear around this variant showing in bonds. And now it looks as though those bond investors, at least today, at least just this afternoon, it is day by day, minute by minute, looking past that.
And Kriti, it's amazing. If I look at the leaders in the S&P 500 right now, and there's not a lot of green there, but there is a little bit. It's Carnival Corp, it's Pfizer, and then it's Clorox. I mean, what do you make of that? I know that Carnival reported earnings this morning, but come on.
Yeah, well, this is the really interesting piece of the story here, because Carnival was actually one of the worst performers at 9:30 this morning. And then it really flipped, and now it's one of the biggest with 3% change here. The thing to keep about Carnival is that they had this tiny little nugget here. They missed the earnings. They had horrible numbers. You had this Omicron variant. But then on top of that, they said, well, the cash burn is actually much, much lower. And you're also seeing on top of that, they're expecting to be profitable in the back half of 2022. That sounds like a very far time away. But for a company that's been largely dependent on debt issuance and stock issuance, to say that, well, in the near future, say 6 months down the road, we might not need that dependence, that's a really good thing for the company.
Perhaps helping out some of those peers as well. Kriti Gupta will be back with us in just a little bit with her chart of the day. Abigail Doolittle, Bloomberg Markets reporter, thank you so much for joining us. Let's do the Bloomberg Business Week Bite of the Day. It's one number that tells us a lot. It's brought to you by GEP. GEP helps businesses transform supply chains with strategy, managed services, and AI-based cloud-native software. You can learn more at GEP.com. Today's number is 11 billion. Elon Musk said on Twitter that he'll pay more than $11 billion in taxes this year. That's an amount that could constitute a record payment to the U.S. Internal Revenue Service. The unusually high levy comes after Musk exercised almost 15 million options and sold millions of shares to cover the taxes related to those transactions. What do you think, Katie?
I don't know. That's a lot of numbers. It's a lot less than Senator Elizabeth Warren would like him to pay, though.
All right, to be continued. Well, speaking of the senator, let's head to Washington, D.C. for a check of the latest world and national news. Nancy Lyons is back, and she's standing by in the 99.1 newsroom in D.C. Hey, Nance.
Hey, Tim. Senate Majority Leader Chuck Schumer says he will hold votes early next month on President Biden's Build Back Better plan. That's even after Democrat Joe Manchin told Fox News he's a no. Pangea Policy founder Terry Haynes tells Bloomberg the moderate from West Virginia left the president's tax and spending agenda in limbo.
He said he would like this to go through the regular committee process and be properly vetted instead of what I called kind of the 100 senator negotiating whack-a-mole style that had been going on. You know, maybe they ought to do that.
Terry Haynes says there's still time for Democrats to recalibrate. Senator Schumer plans to hold a special meeting with this caucus tomorrow. Moderna says a booster dose of its COVID-19 vaccine should offer protection against the rapidly spreading Omicron variant.
Moderna is working on a vaccine that is tailored to protect you specifically from the Omicron variant. But the company says they've also found a booster dose saw a 37-fold increase in neutralizing antibodies. And the company tested a larger booster dose, which increased antibody levels 83-fold. The results support the theory it'll take 3 shots to neutralize the fast-spreading Omicron variant. Moderna plans to start testing its Omicron-specific vaccine in humans early next year. In Washington, I'm Amy Morris, Bloomberg Radio.
Former President Donald Trump is suing New York Attorney General Letitia James to attempt to block a civil probe into his company. He calls it a political fishing expedition. Global news 24 hours a day, on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
Thank you so much for that update, Nancy Lyons. Tim Stenivek and Katie Greifeld live in the Bloomberg Interactive Broker Studio on this Monday afternoon. Katie, I was thinking last week, it's just a matter of time until we start to hear about big conferences around the country, and indeed around the world, start to get canceled or postponed. Then sure enough, this morning, very early, we learned that the World Economic Forum has postponed its annual meeting in Davos next month, thwarted for a second year by fresh waves of coronavirus across Switzerland and across the globe.
Tim, I hate to say it, but I feel like you called this.
I kind of did.
We were talking about this last week.
Yeah, thanks for the credit. I should have tweeted something about it so it was, time-stamped.
Oh, man, you could have quote tweeted
Here's
yourself.
my question. When is CES? Like, when do we hear about CES?
You would think that's coming. Any conference in January I would think is on tenterhooks right now. I'm supposed to go to Miami in February, so I'm hoping that...
Ooh.
I don't know. It looks a little tenuous at this point. But yeah, we'll see. It feels like they held Davos as long as they could, but finally getting the decision today that will be postponed at least.
Yeah, postponed until this summer. The organization was meant to hold the meeting January 17th through 21st. Now, though, the continued uncertainty over the Omicron variant has forced a rethink, and it's now planning to host the meeting in early summer. Katie, when we talk about rising case numbers and we talk about that as a metric for why stocks perhaps move or why bonds perhaps move, I think the important thing to think about is the way that it changes people's behavior and the way that it changes the way we live. And I think that's one part of the conversation that's often lost, because if we do have a cancellation of an event like this or the postponement of an event, that affects the economic impact of the event. It affects the people who were set to travel there and spend money to get to that conference. And it has serious repercussions about the way that I think people behave as well. So if people are hearing about rising case counts, then perhaps they will be less ready to travel and spend money.
That's why it's hard to take Carnival's numbers with too little a grain of salt at this point.
That's certainly right. We're going to have much more on the virus in just a few minutes. This is Bloomberg Radio, and this is Bloomberg Business Week.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
The equity market remains at lower levels at this hour, but the good news, if there is some, is that we are off session lows. We've been on the defensive the entire session. A couple of negatives that the market has been struggling with, not the least of which Senator Manchin rejecting President Biden's current tax and spending package. Economists over at Goldman Sachs consequently reduced their forecast for U.S. economic growth next year. GDP, Goldman says, will now be around 2.9%. That's down from their earlier estimate of 3.3%. At the same time, we're contending with a spike in COVID cases, particularly in Europe, where some of the biggest countries have introduced more restrictions. Right now, we're seeing the Dow weaker by about 1.4%. In the broader market, S&P 500 weaker by about 1.3%. Financial, material, and industrial shares leading the way lower. NASDAQ comp off about 1.3% as well. And then where the small caps are concerned, the Russell 2000 down just about 2%. Trading volume very light, not to be surprised, right? It's a holiday shortened week, and anytime you have thin markets, we likely get a little bit of exaggeration in some of this price action. Crude oil tanking with WTI down about 3.7%. We're trading 68.25 now. And in the bond market, 10-year Treasury with a yield of 1.41%. I'm Doug Krisner, and that is your Bloomberg Business Flash.
Thank you so much for that update, Doug Krisner. Well, Katie Greifeld and Tim Stenbeck live in the Bloomberg Interactive Broker Studio in New York. Katie, we talked about the World Economic Forum postponing its annual meeting in Davos. That had been slated for January. This amid fresh waves of coronavirus across Switzerland and the globe. Just as you and I were speaking just now, or as Doug was speaking, I got a notification that more events in my own life have been canceled in the coming days, and it certainly makes sense that we're starting to see that.
Absolutely. And I mean, there were headlines crossing the terminal this morning that school closings surging 81% too. So it's conferences, it's schools, it's workplaces, it's everywhere.
All of this happening when we expect millions of Americans to be traveling to see one another for the holidays coming up. Let's talk about it with Dr. Peter Alperin, Vice President of Doximity. It's a platform for medical professionals. Dr. Alperin joins us once again on the phone from Austin, Texas. Dr. Alperin, how are things in Austin, Texas right now?
Well, thanks for having me on the broadcast. Things in Austin are going pretty well. We are seeing an uptick in cases, but in general, people are, being careful. I think people know what to do in terms of masking, and it's not the Christmas we had all hoped for, but you got to be vigilant.
Well, help us understand what it looks like on the ground there, because I think a lot of people are really stuck in their universes right now. And if you live in New York City, here's what you know. You have to wait in line for hours to get a COVID test. And if you want to get a rapid test, you have to go to, you try to get one at a pharmacy, and they're all sold out. Are you seeing that in Austin right now?
Yeah, we're definitely seeing pressure on the places where you would go to get tests, as well as the home test that you would get in the pharmacy, as well as and a lot of people who have gone online. Those are also very much sold out. So
too bad. I was going to ask you to snag some for me and send them my way. No, I'm just kidding.
Doctor, I am curious to hear your perspective on the sort of inevitability feeling that is percolating, at least in New York City. I mean, I've heard time and time again over the past few weeks that, oh, well, I'm going to get it anyway. And I mean, does the data that we have on this variant stack up against that? I mean, we've heard a lot about how much more easily transmissible it is, for example.
Yeah, I think, inevitability is a pretty strong word. Here's what we know, right? We know that Omicron is indeed
trillion of U.S. Treasury securities. It's a big market. It's the market that tells every other market what to do. That's a start. At least that provides some context in understanding that why Janet Yellen, for one, the Treasury Secretary, who is arguably, one of the smartest people to be in that position, has said that most of the inflation that we are experiencing still is related to what you would call supply shortcomings, bottlenecks that result from people being immobilized by the pandemic. I think that it's very important. It's something we do at Bloomberg, which is, what does the market tell you that is relevant to whatever people are saying politically? And oftentimes the market is saying something that's very different from what the politics are. And, you can expect politicians to say whatever they can because it suits their interests. But the market is not ideological. It's not political. It's just looking for relative value.
And I'm curious, you mentioned the bond market in terms of what the market is saying. Clearly the bond market, when you look at those long-term rates, doesn't seem too stressed about inflation. When you look across the asset picture and you look at the stock market, do you see a similar message there?
Yeah, for the same reason. Look, when you have interest rates as low as we have, stocks have been the right investment. That's been proven over the past decade or more. And unless that changes, that equation changes, it's likely that stocks will continue to hold their value. Now, one of the other parts of this is, remember, when 2020 began, very few people thought we would have the vaccine that would prevent infection of COVID-19. And yet we did have not just one, but several vaccines. That's called innovation. Innovation is very much a part of the stock market. That's where you've seen companies simply become household names practically overnight because they've created value where there was none. Whether it's a Twilio, which is relatively recent, or it's a Tesla, or even going back further, Amazon. All of these companies are creating value, and that's why the stock market is so attractive.
The column is Biden's economic performance is unbeatable. Matt Winkler is editor-in-chief emeritus for Bloomberg News. He wrote this piece for Bloomberg Opinion. Be sure to check it out on the Bloomberg terminal and at Bloomberg.com. Let's head now to Washington, D.C. for a check of the latest world and national news with Nancy Lyons in the 99.1 newsroom in Washington, D.C. Hey, Nance.
Hey, Tim. Jury deliberations are underway in the trial of the former Minnesota police officer Kim Potter, who is accused of killing black motorist Dante Wright. Minnesota Assistant Attorney General Aaron Eldridge says Potter was negligent when she fired her gun instead of a taser.
The defense will tell you that Dante Wright is somehow to blame in causing his own death. But make no mistake, we're here because of the defendant's actions, not Dante Wright's.
Potter is charged with first-degree and second-degree manslaughter in Wright's death. Her attorneys say she made an honest mistake. Senator Joe Manchin has thrown the White House and Democratic leaders a weekend curveball by publicly rejecting the Build Back Better plan after weeks of negotiating. As Bloomberg's Irv Chapman reports, some are worried about what it could do to the economy.
Economists have started to trim their growth forecasts, in particular because one element of government spending has been allowed to expire. Julia Coronado, president of Macro Policy Perspectives, explained in a Bloomberg interview.
The main near-term impact is the loss of the child tax credit. So some 35 million households receiving several $100s a month. And a lot of these are working class households that tend to spend the money. So there will be an immediate impact.
Coronado said the economy remains strong, though a hit to travel and socializing from Omicron could also have a near-term impact. In Washington, Irv Chapman, Bloomberg Radio.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. Now back to you, Tim and Katie.
Thank you so much for that update, Nancy Lyons. Tim Stenivek and Katie Greifeld live in the Bloomberg Interactive Broker Studio here in New York. Katie, we talked about this. Gosh, was it last week? Was it Thursday? It was Friday because you and I were anchoring together. Mm-hmm. But it seemed like every hour there was some sort of new headline that crossed the Bloomberg terminal that was indicative of rising concern about cases. Among the latest is a story by Catherine Doherty that crossed just a little over an hour ago that Bank of America is now telling New York-based employees who are scheduled to be at its offices they can work from home over the holiday weeks if they prefer, as Wall Street continues to navigate this fresh wave of virus outbreaks.
And you're seeing this across Wall Street, too. I mean, this move from Bank of America, it follows a number of similar issues last week. I'm thinking about Citigroup, Citadel, that is a hedge fund. They both issued similar guidance that at least through the holidays, feel free to work from home. It'll be interesting, Tim, to see if that sticks around because a lot of these Wall Street firms, they've got very expensive rents. They've been really eager to bring their workers back into the office. Obviously, the rise of this Omicron variant scrambling some of those plans.
Well, that's the part that is really, I think, puzzling to a lot of people. Well, perhaps not puzzling, but perhaps sort of at this point, at least if you're in New York City, expected. I don't know how it's reading out in other parts of the country, but we know this is something that is absolutely geographic right now. You can just look at any sort of heat map showing where tests are spiking. I spent some time over the weekend with a friend who had just flown in from California, and he told me that things are totally fine where he came from. And in fact, he decided to leave New York City early after being with me over the weekend, even though we were just outside, eating outside, but he decided to leave the city early because he was headed to another part of the Northeast to be with family.
I mean, it makes sense when you think about how dense the city is. How you get around, you have to get on the subway in some sort of crowded public transit vehicle. It's just entering into New York City, the mood is grim.
The mood is, that is, what's the term you use?
It's bleak.
Bleak and the vibes. Yeah,
the vibes are bad.
Yeah, they are. Well, fortunately, to improve our vibes, we are right now joined by Joel Weber, editor at Bloomberg Business Week. He joins us on the remote from Brooklyn. Also joining us is Rebecca Greenfield, the diversity team leader for Bloomberg News. She joins us on the phone from Brooklyn. Rebecca's latest story in Bloomberg Business Week, it's available now on the Bloomberg terminal and at Bloomberg.com. It talks all about company culture, but what is company culture if you don't actually have an office? Joel, I want to bring you in here because Judith Carr Rodriguez is the CEO of FIG. It's a New York City-based advertising firm. Things were going pretty well for her and FIG, even though people weren't in the office. So why get people back to the office?
Well, that is ultimately what the story's about that Becca did, and I, the thing that I think everyone is acknowledged now, and this is sort of how Becca opens her story, is that forever in the before times, everyone was resistant to working remote because productivity was going to be an issue, right? And then all of a sudden everything went remote, and that excuse didn't quite work anymore, or justification didn't quite work anymore. So now what we're seeing is that CEOs, executives, consultants, there's this other thing that has come up as sort of the new code word, which is culture. And as Becca, I think, does a great job of exploring here, is there such thing as culture when you don't have a place that you all go work at? And so, Becca, what is culture?
Hey, thanks for having me. Yeah, so, this is just the word that kept popping up over and over when I was talking to CEOs, and I was just like, why do you want people back? You're making money, you're doing well. And they all were really scared about losing this idea of the company culture that they'd worked so hard to build and why they believe they're so successful. So I wanted to dive into that, like, what is culture and do we need an office for it? So I talked to the people who study these kinds of things, and you'll hear lots of different definitions of what culture is, but my basic understanding is it's just something that develops when people spend time together or work together, or humans develop cultures. That's kind of what happens. They say no matter what, it will emerge. And, offices do have specific cultures, and some offices have positive ones and negative ones, and parts of our cultures are good. And those are the things that CEOs are holding on to. But the other thing is that culture can also exist, in remote workplaces. In fact, it does exist in remote workplaces. And so I thought that was a really interesting idea of, like, well, if your people are going to be working remotely and they're going to develop cultures, just kind of try to cram them back in an office isn't really going to address the reality of the fact that a lot of people are working remotely and they're going to be developing new cultures there.
And so, Rebecca, this is complete anecdata, but I feel like whenever we get a headline, I feel like I've heard bank executives in the past year use culture, that they want to build a culture, as sort of a reason for why they're pushing workers back into the office. And whenever you see a big story like that, the response on Twitter and other places tends to view that as, again, kind of an excuse just to bring workers back. Is that what you found, in talking to workers and reporting this story? Do employees and workers actually buy that?
I think it's kind of like, it's not untrue that there is a culture in the office. And I think a lot of people now are are kind of do have this cynical view of the workplace and saying like, you're just trying to bring us back. It's just an excuse. And I'm not saying that I don't fall so far in that direction. I do think like, yeah, there is a culture in office, and it's one that bosses like because they can physically see what's going on. They can have power over everyday interactions in ways that is harder when people are remote. And I think that's what the bosses are kind of trying to articulate, and the workers are saying, well, we don't really care. We'd rather prioritize other stuff in our lives, which is totally reasonable. So I do think culture is real, and I think a lot of people, like a lot of the anecdote you're talking about, is like people just want to pretend it's not. But that, like all the people I talk to say, is culture will develop no matter what. And you certainly don't want to work at a place with a bad culture. And I don't mean that by saying like work at a place that doesn't have a ping pong table. I mean, you don't want to work at a place where there's harassment or bullying or burnout or sexism or racism. Like that's all culture too. And I think that's what I mean, where you want to work at a place that has a healthy culture.
Speaking of which, you mentioned some of the people you spoke with. One of the names that popped for me was Matt Mullenweg, who is the CEO of Automatic, and before he was at Automatic, his side project in college was WordPress. So I'm wondering, what did you learn from him? Because his quote to you was, "I love thinking about culture." How does he think about it, and what did you pick up on from him?
Yeah, so he's kind of become the sage for remote work, or what he likes to call distributed work. He built this company of, I think, 17 or 1,800 people, and they've never had an office. People work all over the world, and he's been doing this for a really long time, I think 16 years. So he, in this time of upheaval for most businesses, he's just, kind of been doing the same thing he's always been doing, and people have been coming to him and saying, like, tell us about your theories. And I think, like, he also cares about culture, which is to kind of underscores my point that like culture doesn't just go away because you're working from home and don't have to like sit next to your coworkers. But I think it was kind of interesting to talk to him because the things he was saying were things that I thought, some of the things were like, use these internet tools to facilitate some of the things that might make people feel more connected. But the thing that really stuck with me is, he was like, you just have to be a very clear communicator. You have to have empathy for your colleagues. And those are things that like really much any boss or company should do. And if your employees are resisting coming back into the office, like maybe you should be doing those things better in the office also. So that was what stuck out to me about talking to him, which is like that it's the things he does aren't necessarily that high tech or particular to the remote work world.
Rebecca, this comes at a really interesting time because, as Katie and I were just talking about, Bank of America is now telling employees they can stay home. We learned last week that some of the biggest tech companies in the world are now postponing going back to the office indefinitely. I wonder, and you're reporting for this, how all of this sets up for 2022 and what we can expect to hear when it comes to companies talking about culture. And being that being an essential part of the reason why you should come back to the office. Like, what should an employee counter with if they don't necessarily agree with that?
Yeah, I think like these variants have really, upended the short-term plans, but I still am hearing over and over that long-term people think that offices are important. People being the people in charge who would make you come back.
The ones who are paying leases on buildings.
Yeah, and I think like that, I think the longer we work from home, the easier it will be to work from home more often. I think like a lot of people suspect that, people probably won't mostly be working from home 5 days a week. I've been going in. I enjoy the office. I think I should say that. I'm not anti-office, but I also like parts of working from home. And so I think the longer that we, the times where we have to like, oh, you got to all go back home, it'll just be harder to bring people back. And so it's really more of a message to the people in charge to try to figure out like how, if they're so into their cultures, like how can they create those and maintain those with people not coming in every single day. or make people come in every single day, and that'll be the kind of culture that you're promoting, and certain people probably won't want to work there.
Well, it's a great read, and it's perfect timing, as I mentioned. Rebecca Greenfield, diversity team leader at Bloomberg News, she wrote the story, "What Even is Company Culture If You Don't Have an Office?" You can read the full story on the Bloomberg Terminal and at Bloomberg.com. Also joining us, Joel Weber, editor at Bloomberg Business Week. He joined us from the remote in Brooklyn. Well, coming up in just a couple of minutes, it's our countdown to the close with our friends at Bloomberg TV. This is Bloomberg.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is Countdown to the Close. With 60 minutes left in the trading session, Caroline Hyde, Taylor Riggs, Shonali Basak, joined by our colleagues Katie Greifeld, Tim Stenovic, as we together welcome in full our Bloomberg audiences across TV, radio, YouTube. And it is a day of risk aversion. Once again, Tim, it is a concern about Omicron, a concern about fiscal stimulus in the United States too.
Yeah, sort of a double whammy for U.S. equities. I do think, though, more of the sell-off that we're seeing is Omicron related. I do wonder, too, to what extent we can expect to hear from the president and his team about potentially salvaging what they can when it comes to the Build Back Better plan, the backbone of President Biden's policy agenda, given the comments that we got from Senator Joe Manchin over the weekend, Katie.
Tim, I agree with you. I mean, comments that we've heard all day. It seems that more of the mood in markets right now has to do with the variant more so than Biden's economic agenda. And I just want to point out, if you look at the S&P 500 right now, leading is Carnival, Pfizer, and Clorox. So
kind of wild, right?
Weird setup there. But again, looking across risk assets, across markets, it does seem like variant concerns are front and center, especially when you think about the global nature of this sell-off.
Very well said. Europe on a down day, the Euro Stoxx 50 closed off by 1.3%. 1.3%. Let's look at the majors in the US. S&P 500 down by 1.3%. That is down 61 points. We're at 4,559. Meanwhile, we see similar moves in big tech. The Nasdaq off by 1.3%, down 196 points. And a 525-point move for the Dow, currently off by 1.5%. Small caps feel it heavy as we worry about the economic growth story. Goldman Sachs downgrading their viewpoint on that, on the Build Back Better curtailment, off by 1.9%. Remember, though, volumes are thin to a certain extent, Shonali. We are seeing volumes down by about 5% already versus your usual.
Yeah, absolutely. It's a lot of red on the screen, though, right now, still with those lighter volumes. We do have the indices here, with the financials really leading the index lower, the S&P 500 lower. Materials also down more than 2%, then followed by industrials also down more than 2%. Less bad as consumer staples, less than 1% lower.
And let's take a look at some of the individual movers, of course, that we're following today as well. Shonali, take a look at, well, we call it DNUT. I guess you could call it Krispy Kreme as well, with some of the more recently publicly traded companies. They updated their full year guidance and they're passing on cost to consumers, but Truist Securities is saying that the variance impact is still unclear on this stock. It's down 7%. In a similar story, 7%. Rocket Companies, they're in agreement to purchase Truebill. It's a personal finance app helping consumers manage aspects of some of their personal lives. I guess maybe the street not loving that deal, at least to start on its face. And this is one that we just talked about, at least on TV here in our Stock of the Hour. Oracle and Cerner are at least expanding into the healthcare space, and it had been rumored, and you're finally getting some real meat to this deal as well here, Caroline.
Let's talk technicals as well, though, because I mentioned that there's not only a concern about Omicron, there's a concern about, of course, the fiscal stimulus. These are the fundamentals. What about the technicals at play as we head towards the end of the year, as people take their foot off the gas, they start to try and ensure that they're getting more okay with their risk stance heading into the holidays? I'm also looking at the technicals where we are sub a 50-day moving average on the S&P 500. What does that mean, Tim, in terms of your desire to go long equities into the holidays?
Yeah, do the dip buyers who we've seen so reliably come in after each and every dip, do they come back and buy this dip? Hey, a lot of our focus of the day, too, has emanated from Washington and, of course, from West Virginia as well, where the state that Senator Joe Manchin represents. Let's take a listen to what he had to say over the weekend about Biden's Build Back Better agenda.
If I can't go home and explain it to the people of West Virginia, I can't vote for it. And I cannot vote to continue with this piece of legislation. I just can't. This is a no on this legislation.
Let's talk more about Joe Manchin. White House Press Secretary Jen Psaki is about to start her daily press briefing. Let's listen in.
This included 9 district court judges, bringing the total for the year to 40, more than any president in his first year in office since President Reagan. But it's not just the sheer number of people nominated and confirmed. As the president said at his commencement address last week at South Carolina State, he's proud to have appointed more black women to the circuit courts than any administration in American history. We've confirmed the first LGBTQ woman ever to serve as a federal circuit court judge. And these 40 judges include people who have previously served as public defenders, labor lawyers, and civil rights lawyers, as well as prosecutors and government attorneys. The Senate also voted to confirm 41 ambassadors to countries around the world, including critical allies such as including Japan, France, the European Union, and more. These qualified, competent leaders can now finally get to their important work representing America's interests abroad. There's a lot of work to be done, and we'll continue to work with the Senate to make sure we have the people in place so that we continue to serve the American people. Also wanted to note that the Department of Justice announced today that they'll be awarding $1.6 billion in grants to support a range of initiatives to reduce violent crime and make our communities safer. This money will help address the surge in gun violence that we've seen over the last 2 years and will bolster steps that the administration has already taken to crack down on violent crime, including the president's comprehensive strategy to prevent and respond to gun crime in June. These grants will help advance community violence intervention programs. They'll support evidence-based police and prosecution strategies. They'll ensure the victims of crime get the resources they need. They'll help people returning from prisons and jails transition successfully back into their communities, and they'll support responses to crises like drug overdoses and mental health episodes. This is just the latest example of historic levels of funding that President Biden has made available to cities and states to address crime, including through the rescue plan, through investments in proven community violence intervention strategies that we announced in April, through the COPS community policing grants announced last month, which are helping to put 1,000 more police officers on the beat across 183 police departments this year, and through early Department of Justice awards, including $1.2 billion for victim assistance and compensation programs and more. With that, I would say, since there's space in the back, why don't folks who are standing sit in some of the back seats, just because I know everybody's focused on the spacing in these days. Go ahead, Colin.
Okay, a couple things. So on Omicron, cases are rising dramatically across the country. Americans are still traveling en masse. Biden is giving a speech that has been labeled urgent, but the speech is tomorrow. The vice president also was saying that scientists were caught off guard by the variants, and then there's been pushback from the scientific community on that. So can you help just talk a little bit about what the White House's message on Omicron is? What should the public be thinking? How should we be concerned? What should we do? And then the second one, I'm sorry, I'll ask you after. Go ahead.
Absolutely, Colin. Well, let me first say that the president, as you noted, will be addressing the American people tomorrow, and he'll talk about what to expect as we head into the winter months and detail additional steps that we will be taking. The president has been clear that while vaccinated individuals get COVID he will restate tomorrow, I should say, that while vaccinated individuals get COVID due to the highly transmissible nature of Omicron, their cases will likely be mild or asymptomatic. We continue to see, and our health experts assess, that you are 14 times more likely to die of COVID if you have not been vaccinated versus vaccinated. Importantly, he'll restate we're prepared and that fully vaccinated individuals have the tools to protect themselves with a booster shot and masking where CDC recommends. For those who choose to remain unvaccinated, he'll issue a stark warning and make clear unvaccinated individuals will continue to drive hospitalizations and deaths. That is not trying to scare people, or maybe it is trying to make clear to people in the country what the risks are here of not being vaccinated. What is clear is that we're not in the same place that we were in. This is something he'll reiterate tomorrow as well. The beginning of the pandemic, thanks to the president's extraordinary work to get over 200 million Americans vaccinated. To be clear, COVID-19 is not the same threat to fully vaccinated individuals that it was in March 2020. And I outlined some of the reasons why. And again, as I said at the top, he will also announce additional steps. So he will outline this clearly tomorrow. He has been candid and he has been direct as he's provided updates to the American public throughout on our steps to address what we know is an unpredictable virus and our fight against a once-in-a-generation pandemic. But that's what people can expect tomorrow.
Okay, thank you. On the negotiations over Build Back Better, we see Senator Manchin's version of events sort of differ from the White House's version of events in your statement on Sunday, which was yesterday. It was a long time ago. I just wanted to know if you could talk a little bit about like where the gap is, if the negotiations fell apart over the child tax credit issue, if the White House is prepared to go around legislation on the CTC if necessary. Kind of where are we with Manchin?
Well, I would say I think the lengthy statement that I issued yesterday outlined pretty specifically the events of the last few weeks. And it was important to the president and to all of us to make that clear to the American people, the status and the steps that had been taken. But I'm not going to relitigate the TikTok of yesterday from here today. I will say that from the president's viewpoint, and I saw him this morning, he's worked with Senator Manchin over the course of decades. They share fundamental values. They're longtime friends. That has not changed. And what's most on the president's mind is the risk of inaction. And if we do not act to get this legislation done and the components in it, not only will costs and prices go up for the American people, but also we will see a trajectory in economic growth that is not where we want it to be. And we've seen projections from Goldman Sachs and others today on that front. So he's no stranger to legislative challenges, and we are going to continue to take steps, work like hell to get it done. Go ahead.
Does the president feel betrayed by his friends?
I think our statement yesterday made pretty clear what we feel, what was the factual depiction of events that happened. But again, the president sees Senator Manchin as somebody who is a longtime friend, somebody who has worked well together on, and our objective and our focus now is moving forward.
And where do the lines of communication stand at this point between either the president and Joe Manchin and the White House staff, which you spoke about? Is there a contact at all?
I'm just not going to assess or give you an update on specifics from here.
Okay, just quickly on COVID, ahead of tomorrow's speech, should Americans expect any new restrictions?
This is not a speech about locking the country down. This is a speech outlining and being direct and clear with the American people about the benefits of being vaccinated, the steps we're going to take to increase access and to increase testing, and the risks posed to unvaccinated individuals. Go ahead.
Does the president still trust Senator Manchin?
Again, I understand the questions here, but our focus is on moving forward. I think our statement yesterday made clear what the course of events were over the last couple of weeks. It was important for the American people to know and see that, but he considers Senator Manchin a longtime friend, and our focus is on moving forward and getting this done.
Are you confident that all 49 other members of the Democratic caucus are still on board with Build Back Better?
Sure, I understand that. I can't obviously speak for all of them, but I think you saw quite a bit of unanimity yesterday in the response of people and their desire from across the Democratic Party and the desire to get this legislation done.
What would be his message to progressives who he asked to hang with him as things moved over to the Senate, now that what many of them warned has happened?
Well, I would say, one, his message would be we need to work together to get this done, and he's going to work like hell to get it done. And that would be his message, and January is an opportunity to do exactly that.
Quickly on Ukraine.
Yes.
The State Department issued a level 4 travel warning today, saying U.S. citizens should be aware of reports that Russia is planning for significant military action against Ukraine. Jake Sullivan spoke with his Russian counterpart again today. Apparently over the Pentagon, they've just said that they've conducted an assessment of air defense needs in Ukraine. Obviously, you've said you're monitoring this. Is U.S. intelligence picking up something new?
Well, let me first say that the travel advisory for Ukraine remains a level 4. Do not travel due to COVID-19. The State Department updated it to include information on Russia's military buildup on Ukraine's border, just to provide additional information, but it has been at a level 4.
So nothing new otherwise?
Well, again, the State Department provides additional information through travel advisories to make sure they are being transparent with American citizens who are in different countries, and that's exactly what they did in this case. And we have historically seen large numbers of Americans and others, of course, traveling to Ukraine during this time of year and the holiday season, so it was just an effort to provide that information directly. Go ahead.
Jen, your statement yesterday alluded to working more on Build Back Better next year. Is your expectation that President Biden and Senator Manchin will talk at all before the end of the year?
I'm just not going to give you any updates on their engagements from here. I wouldn't expect, and we're going to keep those private.
Got it. And do you regard his $1.8 trillion proposal as a non-starter, given that it excludes child tax credit?
I think the president has been clear about, and I'll let Senator Manchin speak to the specifics of his proposal. I'm not going to confirm those details from here of what I know. I know there have been reports out there, but I'll let him speak to that. But I would say that the president, of course, wants to extend the child tax credit. That's something he has spoken to. We know that it was a significant contributor to cutting in half the child poverty rate. I'm obviously not going to negotiate from here, but he doesn't think compromise is a dirty word either.
Good question. On Sunday, New York City Mayor Bill de Blasio asked the president to invoke the Defense Production Act because of a shortage of at-home tests, monoclonal antibody treatments, and he also said that the Pfizer antiviral pill should be fast-tracked. Are any of those things under consideration at this moment?
Well, we're in touch, I will say first, with the City of New York and the state, as well as all officials across the country experiencing upticks. We've sent 30 ambulances to the state and an accompanying team of personnel to help balance patient loads among hospitals across the state. We've already used the Defense Production Act and spent $3 billion to greatly expand the number of at-home tests, so that's already something we have tapped into. And as I noted earlier, the president will have more to say tomorrow in his remarks about our efforts to expand access. Go ahead.
Senator Manchin this morning in a radio interview said this is staff, and they drove some things that they put some things out that were absolutely inexcusable. They know what it is, and that's it. Do you know what he's referring to there, and do you have a response to his comments about the staff?
I don't. I would point you to Senator Manchin to outline further.
And then can you walk through, and I know you don't want to talk about yesterday's statement, but the cost benefit of, you guys have been so cautious, I think at the president's direction, of never speaking ill or laying out details of negotiations, what the calculation was by deciding to put out a 700 plus word statement being very clear about, I think, some palpable anger inside the White House related to a critical vote in the caucus.
Well, I think Senator Manchin had a strong statement yesterday, and we had a strong statement as well. And we're ready to move forward and get this done and work like hell to do that. With Senator Manchin, with members of the Democratic caucus across the Democratic Party, and that's our focus moving forward. But that was our basis of our calculus yesterday.
And just one more quick one. My understanding is what Senator Manchin put on the table, which you referenced in your statement, was it a final offer? It hadn't been rejected. It was kind of a process that was underway. What is the process now? Are you working through proposals? Is staff dealing with policy issues? Where do things go from here in terms of the actual proposal?
Well, clearly the next couple of weeks will be important and pivotal and certainly involve high-level staff engagements, involve the president and his engagements directly with members. And we have been engaged with leadership, with members of the Senate and their staff over the course of the last 24 hours to talk about the path forward. You saw, I'm sure, Leader Schumer's statement this morning, and we will stay in close touch and in close coordination with him and his team on the path forward in January.
Well, you've been listening to White House Press Secretary Jen Psaki live from the White House. To continue listening to her press briefing, you can check out Live Go on the Bloomberg terminal. The White House says that Biden is, quote, no stranger to legislative challenges. The Biden speech on Tuesday is not about locking the country down, Jen Psaki said. She also alluded to January, saying that there's an opportunity to get the economic plan done in the country, saying also, of course, that President Biden wants to extend the child tax credit. Also saying the next few weeks will be, quote, pivotal for the Biden agenda. Again, to check out what she has to say, click Live Go on the Bloomberg terminal. Let's get a check of the latest what's going on with the trading day as we do countdown to the close. Here's Doug Krisner.
Hey, Tim, we got about 42 minutes until the closing bell. The Monday session has really been one of a lot of defensiveness, given the market is really struggling with a couple of negatives. You've been talking about the future of President Biden's economic agenda, some doubt there around Senator Manchin yesterday rejecting it in its current form, and that prompted economists over at Goldman Sachs to reduce their forecast for U.S. economic growth next year. And at the same time, we're seeing a spike in COVID cases, particularly in Europe, and a number of big countries there now introducing some more restrictions. That is only contributing to this defensive posture in equity trading. Volume, though, to be fair, is relatively light. Given the holiday-shortened week, and thin markets tend to produce some exaggeration in price movement. That said, the Dow is weaker by 1.5%. We have the S&P down about 1.3%. Similar drop for the NASDAQ composite as we make our way to the closing bell. Crude oil in New York in the regular session was down 3.7% as the market braces for economic slowing. WTI finishing 68.23. In terms of the rate environment, little movement here. Actually, the 10-year is moving up just a bit in yield terms. We're at 1.42%. I'm Doug Krisner. That is your Bloomberg Business Flash.
Thank you so much for that update, Doug Krisner. Well, in recent years, we've seen U.S. organizations that have ties to China come under increased scrutiny. Among those in recent years, and especially in recent weeks, has been Ray Dalio, of course, and Bridgewater Associates. We're joining us now to talk all about Dalio's China fascination and when it started is Andy Brown, editorial director at Bloomberg New Economy. He joins us on the phone from New York City. Andy, before we get into the history here, why are we talking about this right now?
I think why we're talking about this right now is because Ray Dalio, perhaps more than other Wall Street billionaires, has remained very publicly and very volubly pro-China in his views at a time when political sentiment in Washington, D.C. and public sentiment in the United States more broadly has turned decisively anti-China. And so it makes it seem as though he is somewhat out of step.
And so, Andy, let's dig into that why. Why is Dalio, like you say, still publicly pro-China when a lot of his peers on Wall Street have taken or at least backed away from their support?
Well, I think most fundamentally because China is where the money is and where the opportunities are now for Wall Street giants like Bridgewater, like Blackstone, BlackRock, and so on. I mean, there's been a lot of very negative focus on the collapsing price of Chinese equities as President Xi Jinping cracks down on property and big tech platforms and after-school tutoring and so on. But don't forget the Chinese economy actually is motoring along quite well. It's reasonably healthy. It attracts more direct foreign investment in the United States now. Companies are investing more and more, despite all the talk about supply chains retreating from China. U.S. companies continue to invest there. And indeed, Chinese companies are investing more in the United States. So, big picture, there are opportunities. Plus, and here's the decisive thing for Wall Street, China needs their technical expertise. Right. Doesn't necessarily need the money. It's got plenty of money. But what it needs is expertise to help develop a sophisticated financial industry.
Well, Andy, there's a great new piece published today on the Bloomberg Terminal by our colleague Catherine Burton that talks about Dalio's China fascination and that it predates ties to Beijing's billions, that is the money that Bridgewater handles for China. So take us back years ago, decades ago, to really understand Dalio's connection to China.
Yeah, look, I got to say that there's nothing particularly unusual in Ray Dalio's history with China. I mean, it's pretty much par for the course. This is what Wall Street billionaires do. Over the years, they've invested millions and millions of dollars in charitable good works in China. Ray Dalio himself apparently invested something like, according to our story, something like $150 million. Well, Steve Schwarzman, the founder of Blackstone, kicked in $100 million of his own money into a scholarship program at Tsinghua University, which is President Xi Jinping's alma mater. The Gates Foundation over the years has put in $400 million to fight disease in China. I mean, this is just what billionaires do in order to win influence, one might say curry favor with Chinese leaders.
And Andy, like you just laid out, I mean, across Wall Street, both firms and billionaires courting China. What does that mean for their relationship with Washington? Because if you think of the climate in both parties right now, it seems like the sentiment against money flowing into China, it's pretty negative right now.
Yeah, it sort of puts Wall Street on a collision course with Washington. I mean, the real hawks in Washington, D.C. essentially believe that pumping money into China is giving comfort and support to the enemy. Now, the Biden administration, of course, wouldn't go nearly that far, although it is moving in generally that direction. It inherited tariffs, trade tariffs on China. It inherited sanctions from the Trump administration, and indeed is adding to them. Just the other day, it blacklisted a company called DJI, which is the world's largest manufacturer of drones. So increasingly, there is a tension between Wall Street's ambition for China and Washington's ambition to put economic relations with China into a box.
Andy, while we have you, I don't know if it's going to be the last time we have you before the end of the year, just in the last 30 seconds we have with you, what is the main thing we need to watch between the U.S. and China going into 2022?
Look, the big issue, I think, is Taiwan, that you have a lot of military activity now in the Taiwan Strait, and both the Chinese and U.S. leaders have recognized that it's dangerous and there need to be guardrails.
Andy Brown, editorial director at Bloomberg New Economy, knows all things China, spent years living in China. Andy, thank you so much for taking the time and joining us on Bloomberg Business Week. This is Bloomberg Business Week on Bloomberg Radio. Coming up next, it's the chart of the day.
broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119 and around the globe. The Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
It's Bloomberg Business Week. Tim Stanovic and Katie Greifeld live in the Bloomberg Interactive Brokers Studio. Under a half hour away from the close of trading on this Monday. We are still seeing stocks broadly lower. In just a few minutes, we are going to take a look at the chart of the day with Kriti Gupta and also get an update to the markets and, of course, her story that she has got her eye on today. In the meantime, let's get a check of the markets as we do get close to the close of trading. Here's Doug Krisner.
Hey, Tim, you were talking about charts a moment ago. I was just looking at a chart on the S&P 500, and it seems as though we bounced right off that 100-day moving average. So we are down, yes, but off the session lows here. If you look at the S&P, the loss right now is about 1.3%. Some concerning developments today, keeping the equity space a little bit on the ropes. First, some doubt on the future of President Biden's economic agenda. And at the same time, we're dealing with this spike in coronavirus cases. I think that the economists over at Goldman Sachs were more focused on the fact that Senator Manchin has rejected the current tax and spending package in its current form when they decided to reduce their growth forecast for the American economy next year. Goldman is expecting GDP at a rate of about 2.9% in the year ahead. That's down from their earlier forecast of 3.3%. Trading volume today, relatively light. We have a holiday shortened week. We're aware of that. Thin markets tend to produce some exaggeration in price movement, so bear that in mind as well. Dow Industrial Average off about 1.5% right now. The S&P 500 down about 1.4%. NASDAQ Composite weaker by about 1.4%. And a 10-year Treasury last quoted at 142. I'm Doug Krisner, and that is your Bloomberg Business Flash.
Thank you so much for that update, Doug Krisner. Bloomberg Business Week is brought to you by SEI. Crises and challenges highlight the power of partnership and character. Work for the common good. One community, SEI. Go to SEIC.com/banks. Well, we are just about a half hour away from the market close. It's time now for the chart of the day. Kriti Gupta is Bloomberg markets correspondent for Bloomberg News, and she joins us each and every day at this time with a look at the chart that she's got her eye on. Today, it's all about risk off indeed.
Risk off indeed, and I'm gonna stray a little bit from the stocks and the bonds and the commodities. I'm going to do currencies, which is something that nobody really covers a ton. Katie was just saying that it's a super important part of the market that just doesn't get enough credit.
Well, we cover it a lot here at Bloomberg.
Trillions pass through this market every single day.
Right.
Yeah.
We cover it closely here at Bloomberg.
We do. Well, debatable, but we do. Well, we do, but we don't cover it as much as the stock market or the bond market. It just doesn't get enough credit, especially here. And a lot of that is simply because the dollar is kind of like the currency on the side of the Atlantic. So you don't have to think about necessarily what it's doing relative to other currencies. That's not the case if you're in Singapore or London or Paris or wherever else in the world you may want to be. So my chart of the day looks at two currencies that, once again, we don't really talk about a ton on this side of the Atlantic, and that is the Australian dollar and the Japanese yen. And I like to pair them together because in my mind, they kind of represent the opposites, risk on and risk off. And let me explain why. The Aussie dollar, the Australian dollar, the Aussie, as you may want to call it, is a risk-on currency. It has a lot of commodity exposure. It's very exposed to China in particular, which is kind of a risky EM bet that a lot of people make. And the way to do that a lot of times is to get exposure to the Australian dollar. And once again, Australia and China China is Australia's biggest trading partner. Iron ore is Australia's biggest export. So it just kind of works when you're talking about growth and commodities and that side of the risk-on trade. Compare this to the Japanese yen, which is most well known for kind of being the haven. If something goes wrong in the market, most people kind of flock to the Japanese yen. And for a while, it had to do, just historically, it had to do with interest rate differentials. But most recently, in the last maybe Katie could correct me here, I think maybe 10, 20 years-ish. When,
Sounds right.
Yeah, you haven't really had these super positive kind of interest rate differentials, which you guys don't need to learn that term. It's too nerdy, too complicated. Forget about it. But essentially, this idea that Japan is a creditor nation, so they tend to kind of switch their money into dollars, but in kind of panic mode, they tend to bring their currency back to their domestic currency, essentially. So you see this risk-on, risk-off mode. So for our radio audience, the chart really just shows those two currencies compared to each other. When the line goes up, essentially when the Australian dollar strengthens compared to the Japanese yen, it tends to signal a risk-on mood in the global market. It tends to signal growth. When it goes down, obviously, it means that things are not going well on the growth front. And this has been a downtrend for the last 2 months, actually. You've seen the Australian dollar weaken against the Japanese yen, and it really all started when those Omicron variant headlines first came out in about the middle of October. And the reason this is so important, this is the big takeaway, as Carol would say, why do we care? We care because this has been kind of a roadmap in a lot of ways for other assets like the S&P 500, like the credit markets here in the United States, because it means that if the world isn't growing together, if you don't have that commodity demand, then perhaps the S&P 500 isn't going to be doing that well anyway, because at the end of the day, it all comes down to growth.
Kruti, I'm so glad that you did this chart because I covered currencies for years. You have to beg people to care about them, but they are so important. They're like little sharp knives. They really hurt when they do matter. And like you said, there's an important signal here when you think across risk assets. What caught my eye is that, like you laid out, this trend didn't change until mid-October. I mean, what would cause it to reverse at this point?
Yeah, what's interesting here is that we kind of had a little bit of this scare in July as well. And if you actually kind of zoom out the chart and look at the same thing of what was going on in July when we were dealing with the Delta variant, for example, you saw the same story, this idea that perhaps you would have to have governments go into lockdown, go into curbing restrictions, kind of put a cap on growth a little bit. So you're seeing a little bit of a repeat now. The question, though, is how quickly does it bounce back? Because in July, from July to October, you did see a bounce back because it was kind of this idea that, well, the vaccines that we have do protect against the Delta variant, and that's going to be a similar story when it comes to the Omicron variant. The question here is just, is this a faster spread? Is this a more infectious spread? We're still waiting on that information to see if the market's going to turn around.
Hey, Kruti, just in the last minute we have with you, one thing that we like to do with you is talk to you about a story that caught your eye. The story that caught your eye today is Oracle's acquisition of Cerner. The news broke last week. The deal formally announced today. Why did it catch your eye?
Yeah, well, something we don't talk a lot about is healthcare infrastructure, which is a fancy word for saying we need more databases in the healthcare system. There's a great story over the weekend from Josh Wingrove saying that counting of the COVID vaccines isn't actually being done correctly. So Oracle has actually is most well known for being a cloud business, and cloud businesses mean a lot of things, but mostly it means database storage. And they haven't been able to keep their market share the way that their competitors, Microsoft or Amazon, has. So they're doing something really exciting, which is making a really huge bet, a $28.3 billion bet
all cash
on healthcare,
too.
all cash on healthcare, and they're doing it so much that's kind of straining their balance sheet a little bit to the point that the S&P, the credit rating agency, actually puts them on credit watch negative.
Wow.
So they are at risk.
Does this mean I don't have to fax my medical records from one doctor to another doctor anymore? Can we do this on the blockchain yet?
Maybe
Okay,
one day.
maybe.
We'll see what this deal brings.
Maybe one day. Kriti Gupta, check out her chart of the day, and of course, all of her social media. You can get that at Kriti Gupta News. Let's get to Washington, D.C. for a check of the latest world and national news. Nancy Lyons in the 99.1 newsroom in D.C. Hey, Nance.
Thanks, Tim. With coronavirus cases rising largely due to the transmissibility of the Omicron variant, new steps are being taken to rein in the virus. School closings have surged 81% just the last week. This all comes as President Biden sees his favorability ratings fall due to the surge. But Brown University political science professor Wendy Schiller tells Bloomberg Democrats need to take charge of the narrative and call out Republicans.
We've got Republican governors that are penalizing companies that ask their people to mask up and to get vaccinated. They have to come out much tougher, much harder, and swing. and they have to blame the Republicans. They haven't done that.
Schiller says if Democrats want to politically gain leverage on something beyond their control, they need to get rid of the obstacles, which she says are the Republican governors who refuse to allow virus mitigation measures. Well, concerns about the virus have prompted the World Economic Forum to postpone next month's meeting in Davos.
The meeting was scheduled for January 17th through the 21st, but the forum released a statement saying that because of continued uncertainty, they've decided to postpone the meeting until early next summer. As recently as last week, Switzerland was still open to international travel, but the Omicron variant changed that. Switzerland tightened restrictions, bringing back work from home and requiring vaccinations. The World Economic Forum last held its meeting in Davos in January of 2020. In Washington, I'm Amy Morris, Bloomberg Radio.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
Thank you so much for that update, Nancy Lyons. Tim Stanovic and Katie Greifeld live in the Bloomberg Interactive Broker Studio in New York. Katie, it's not every day, actually I don't think this has ever happened before, where a story that you write, that you graciously gave me a contributor line
I did.
is one that we get to talk about because it's among the most read on the Bloomberg terminal.
What a wonderful opportunity for us.
It is. Well, it has to do with our interview last week that we did with Michael Sonnenschein from Grayscale. Talk a little bit about your story here in the sell-off that we've seen with crypto recently, specifically Bitcoin, dragging the biggest Bitcoin fund to a record discount.
Yeah, it's pretty, the numbers are startling. So we're talking about the Grayscale Bitcoin Trust. This is the biggest cryptocurrency fund in the world. It has about $30 billion in it. But Tim, it's not an ETF, and that matters so much if you are a shareholder in this fund.
We'll talk about why it's not an ETF.
I'm going to tell you why.
Thanks.
It's because the SEC, it's approved futures-backed ETFs. Critical that it hasn't approved physically-backed ETFs, funds that actually hold Bitcoin. So Grayscale has filed to convert this into an ETF. Obviously, with the state of the regulatory environment, they're not able to do that. What that means is that shares of the Bitcoin Trust can't be destroyed in the same way that an ETF could. And what you end up with is this big discount in the share price of the fund relative to the Bitcoin it holds, just because the supply of these shares ballooned during that big bull run we had. Now you're left with a ton of shares, diminishing demand, and you're seeing, again, this big discount, record discount emerge.
This is something you've talked about with Grayscale before, right?
Oh, yeah. We've been following this story for months because this discount opened up actually in February, but it's gotten progressively and progressively worse to the point where the Grayscale shares trade 21% below the value of the Bitcoin that they hold. So if you've been sitting in this fund, just holding it, you're just watching its value get eroded away.
Well, the flip side of that, though, is, well, in just 5 seconds we have left, an opportunity that they would say, well, maybe it's a good idea to buy.
Well, once actually they're able to convert it, that would pretty much erase the discount immediately, but that's a long way away.
This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Under 13 minutes until the closing bell. You know, the equity market has been on the ropes throughout the entire day. A lot of concerning developments. We've got Senator Manchin rejecting President Biden's current tax and spending package, and that caused economists at Goldman Sachs to reduce their growth forecast for the American economy next year. Goldman expecting GDP at around 2.9%. That's down, by the way, from an earlier estimate of 3.3%. And at the same time, we're seeing a spike in COVID cases in Europe, some of the biggest countries there introducing more restrictions. And in Switzerland, the World Economic Forum postponing its annual meeting in Davos. It had been slated for January. Trading volume today, very light given the holiday shortened week. We do have the S&P 500 down about 1.3% right now. Financial shares along with material and industrial stocks leading this decline. NASDAQ comp off about 1.4%. The Dow for its part is down about 1.4%. Crude oil took it on the chin today. We were down in New York trading in the regular session by 3.7%, 68.23. And interestingly, the rates environment was somewhat stable. In fact, on the long end, we actually moved up just a bit with the 10-year Treasury last quoted at 1.41%. I'm Doug Krisner, and that is your Bloomberg Business Flash.
Thank you so much for that update, Doug Krisner. It's 3:48 on Wall Street.
The following is an editorial from Bloomberg Opinion.
Once upon a time, the U.S. spearheaded a global crackdown on financial secrecy, the kind that lets the corrupt and the dangerous hide their ill-gotten gains. Many countries went along, taking action to rein in tax evasion and money laundering. Yet in a spectacular display of hypocrisy, the U.S. went on to spurn the financial transparency that it demanded from the rest of the world. As a result, opaque trusts in states like South Dakota have attracted hundreds of billions of dollars from people seeking extreme financial privacy, and American real estate has become a vehicle for laundering global criminal proceeds. Now President Biden says he wants to set things straight, and as part of an anti-corruption campaign, he's announced important steps in the right direction. It's a good start. The global fight against dirty money needs the U.S. to succeed. This editorial was written by the Bloomberg Opinion editorial board. I'm David Shipley. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPI and Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
Well, we are just under 10 minutes away from the close of trading on this Monday, December 20th, 2021. Tim Stenbeck and Katie Greifeld live in the Bloomberg Interactive Brokers studio. Let's get into it with Michael Sheldon, Executive Director and Chief Investment Officer at Hightower RDM Financial Group. He joins us on the phone from Westport, Connecticut. Hightower RDM Financial Group has $1.2 billion in assets under management, that as of October 2021. Michael, how are you?
Good. Thanks very much. I appreciate your having me.
Well, help us understand what's going on in the trade today. We are bouncing off of session lows, but still we're seeing a sea of red across the screen, a three-day decline, set to close at a three-day decline. I'm wondering if this is more about Omicron fears and the virus spiking, or more about what's happening or what's not happening in Washington, D.C.?
Yeah, I think it's a combination of factors. Obviously, the markets are more unsettled than they have been in some time. I think the main factors are the ones you just mentioned, but to just sort of delve into those, if you look at the Fed has really provided a tremendous amount of accommodation over the past couple of years or so, and they're slowly shifting gears towards removing some of that accommodation. So they're sort of tapping on the brakes just a little bit. But I think it's also important to keep in mind that historically, at least, in the first 12 months when the Fed does start raising rates, and they're still some ways away from that, the equity markets have posted solid returns in that first 12-month period. So that's one thing. And also the Federal Reserve can shift policy. They can adjust policy if need be. The second is obviously the virus. We've had a surge in cases over the past several weeks, and right now there's a lot of uncertainty about what's going on and the virulence of the virus. if you look at some of the data over the weekend from South Africa, it looks like this virus spreads more easily, but may not be as virulent. And then lastly, it's inflation. And obviously, we're seeing some of the highest rates in terms of inflation that we've seen in decades. We think there's going to probably be some moderation in inflation as we go through the year. And I would just keep an eye on very simple things like the number of tankers off the coast of California, or, for example, the Baltic Dry Freight Index, which measures freight rates. And both of those have started to come off. So I think those are the main factors that investors are watching.
And Michael, I'd love to hear your thoughts on what the virus means for inflation and expectations going forward, because obviously, if you look at global supply chains, already very stressed. I mean, if this adds even more stress, if you have people going back to spending their money on goods, I would love to hear your thoughts on whether that, could cause inflation concerns to even become more of a focus.
Yeah, I think it's a great question. And, what's interesting, if you step back for we've been in no normal economic sort of cycle. If you go back to early 2020, when the economy shut down, basically people were at home and they were spending money on things like their home office and their homes and things of that nature. So if you look at spending on goods surged very high. Spending on services actually came down dramatically. People weren't going out to restaurants. They weren't traveling. And so you had a surge in spending on consumer goods. Now I think what you'll start to see as we get into 2022, if we can get past the virus and that starts to settle down, I think you'll start to see a pickup in spending on services, and some of the spending on goods, which is really above the historical levels, will start to cool down. And if that's the case, then you should start to see some of the supply chain issues start to gradually moderate. And we're also seeing a number of people getting back into the labor force. We're not where we were beforehand. We're still several million jobs short, but I think that's heading in the right direction as well. So overall, that sort of combination should eventually help to reduce inflationary pressures over time.
I'm wondering, though, what if, and look, I hate to be so dismal here, but I'm wondering what happens if we don't get the variant under control.
Well, I think that certainly could be a problem, and I think
there's another
that
variant.
Slows down I'm sorry, go ahead.
Or there's another variant.
Yeah, I think we're living in a world right now where there are going to be variations to the original virus that we had. I think, unfortunately, that's just the world we're living in. It seems from the science that the more people who get vaccinated and protect themselves, the more the country can sort of get back on track. And we may not be living in the same world we were pre-2020, but I think the economy has learned to adapt. And I don't see closures the way we had them in early 2020 coming back anytime soon. We could have localized shutdowns and closures, but I don't see anything at a national level.
And Michael, how do you position a portfolio around that uncertainty, the uncertainty about what kind of world we will be living in come 2022?
Well, that's a good question. And importantly, to preface that, I would say that for investors, it's important to point out that economic cycles typically last a number of years as opposed to months or quarters. When you have a bear market of 20% or more decline in the market, that's typically caused by the Federal Reserve raising rates significantly. And they do that when they have to slow down the economy, or sometimes there's an exogenous event like a surge in oil prices. If oil prices were to go up more than 100% over a 6 to 12 month period. So from our perspective, we are seeing some choppiness in the markets, and the markets are lacking a bit of leadership right now. But I think if you look at some of the economic indicators, for example, the leading economic index came out this morning. It's up 9 months in a row, and it's up 18 of the last 19 months. So I think that suggests that looking ahead over the next 6 to 12 months, the economy is likely to grow but remain choppy. So to get back to your question, I think you want to be diversified in your portfolio. I think you want to have some technology in your portfolio, even though there's been news about the concentration in that, but you need some growth in your portfolio to meet your long-term investment objectives. We're looking at healthcare. We think that's one of the forgotten sectors and sort of a GARP, or growth at a reasonable price sector. Mm-hmm. And then you also want to have some exposure to the areas that are likely to benefit when the economy eventually starts to reopen. I guess you could call it reopening 2.0 as we head through the spring into the summer.
And Michael, just quickly, I am curious to hear your thoughts on tech when you think about the market in terms of sectors. We have, just about 30 seconds.
Yeah, we're big believers in tech. There's a lot of disruptive technology going on in areas like the cloud, in areas like artificial intelligence and 5G. You do want to have some broad exposure in those areas. These kind of companies are very innovative, and they're likely to generate the kind of returns within your portfolio. But you do want to have some diversification, and you just want to be wary of the weight you have of technology within your overall portfolio.
Michael Sheldon, Executive Director and Chief Investment Officer at Hightower RDM Financial Group, joining us on the phone from Westport, Connecticut. Well, it does look like we are going to finish off of session lows. The S&P 500 down about 1% right now. Don't go anywhere, though, because we're going to have full coverage of the market close with our friends at Bloomberg TV on YouTube, on Bloomberg TV, and on Bloomberg Radio, with Beyond the Bell coming up in just a couple of minutes. This is Bloomberg.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And we are about 2 minutes away from the end of the trading day. Caroline Hyde, Sonali Basak, and Taylor Riggs counting you down to the closing bell. And here to help us go beyond that bell is a global simulcast. Katie Greifeld, Tim Stenovic, bringing together our Bloomberg TV, radio, and YouTube audiences and dig into what has been the two key topics of the day. Omicron on one side, the concern of COVID, and indeed the concern about Build Back Better, Tim.
Yeah, those concerns, though, potentially easing a little bit, maybe at least according to some dip buyers who toward the end of the day started to come in just in the last few hours, especially in the S&P 500, which was down significantly, but looking like it's going to finish down just over 1 percentage point, bringing three-day declines to under 3%.
Yeah, the mood is definitely risk off. And I know that Taylor's going to go into this later, but it's really interesting to see that risk off vibe has not spread to the bond market. I mean,
How did you know,
knowing
Katie?
Taylor, knowing how this usually goes. I know we're going to get more into yields, but again, the bond market not playing along. You have 30-year Treasury yields up 4 basis points. And it's, again, interesting how it's not helping financials at all. That is your biggest loser in terms of sectors right now.
It's a similar sentiment, Sonali, to what we had on Fed Day when the equity markets were not taking their cues from the bond markets, and then average Thursday the next day it hinted that sort of showed us that something else was perhaps maybe going on. Yields are rising, and you do wonder if it's sort of those inflationary concerns coming back, or maybe it's just sort of a one-day trade that maybe isn't explainable.
Yeah, it's so interesting because do you get cyclical here when you see energy lower, oil lower, financials lower, even with that steeper yield curve? Where do you end up going?
And Katie, you're our options expert. I mean, is the options overhang quickly?
It's interesting to see because if you look at the put-call ratio, I mean, investors have clearly been bidding up protection. So the option market, unlike the bond market, really reflects that same anxiety that has really showed up over the last few weeks or so.
A little bit of anxiety today as we get the closing bells. Confetti nonetheless, celebration at the New York Stock Exchange and the NASDAQ, the S&P 500 falls by 1.1%, 52 points lower, 4,568 is where we end our Monday trade. NASDAQ, 14,980, we're down 188 points, 1.24%. The Dow off by 1.23%. Let's bring it out to what happened on the Russell, though, because small caps, maybe it's the questioning of growth going into 2022. That was the Goldman Sachs call. We're down by 1.6%. We finished the day at 2,139, Tim.
Yeah, look, and we're getting toward the end of the year here and potentially going to see some lighter volume in the coming days as people are off and we get closer and closer to the holidays and to the new year. But I think worth reminding everyone here that, look, it's been a really solid 2021 with the U.S. equity markets, 21.6% in the green on the S&P 500 year to date. So, yeah, it's been volatile of late, but so far so good for a lot of investors long this market.
Yeah, definitely so far so good, but not today as we have most of the major sectors here in the red on the day, led much lower here, more than 3% by the auto and computer. We have some gainers here that are not too much higher on the day, honestly, less than 1%. That's telecom, food and retail. We have utilities still lower on the day, and of course, we've been talking about it, consumer, discretionary, banks, diversified financials, all leading the sector lower, more than 2%. Materials, insurance, also more than 2%. Lower despite the steeper yield curve, guys.
Well, Sonali, there were 425 stocks that ended lower in the S&P 500, but I found some that did gain. I want to start with AT&T. That closed.
Busted. Hunch on the day. You're in the doghouse.
I'm in the doghouse. My gainers are still gainers.
Maybe I think maybe we're looking at what's happening after hours. If we need to flick it back to what happened on the day, AT&T was indeed, as you see, on the gaining, but we do have some breaking news quickly.
I'm good. Okay, because if we look again at the past trading day, I was right. I want to talk about AT&T because...
Katie, can I just be really rude?
Of
I'm just going to break
course,
some
you
numbers
can,
for you
please.
because this is an interesting chip company that is continuing to see actually a beat in terms of its first quarter adjusted earnings per share. And we see it at $2.16. The estimate had been for $2.12. First quarter cash flow from operations, $3.94 billion. That's actually a slight miss in terms of Micron. But we are seeing overall a company that has been weathering some of these supply chain headaches overall, a company that many had felt perhaps had got through some of the pressure on certain parts of the chip sector, is seeing a second quarter revenue at $7.3 billion to $7.7 billion, ahead of expectations. We're rising some 4.8% after hours, Katie. But before we dig more into those earnings, and we're going to get a Bloomberg intelligence analyst on them, I want to go back to Katie. What happened on the day in terms of AT&T?
Well, in terms of AT&T, I mean, it was interesting. You saw a similar move from an analyst that we saw last week. Barclays upgrading AT&T, broadly positive view for telecom stocks in 2022, sees telecom names better positioned than cable names next year. And again, Morgan Stanley also upgraded AT&T last week, giving a boost to shares. They closed up over 1% down day for markets. I can keep going unless you guys want to talk Micron.
No, keep going.
Okay, let's keep going. I do want to talk about Carnival because this one was a real head scratcher for me. They did report earnings this morning, and the fourth quarter was terrible, but the blue skies for the second half of 2022 were there. They said that they do expect to become profitable in the second half of next year, but there is a big question mark over that forecast. It's named Omicron and other variants that might follow, and that is the reason why my last gainer today did post a rally. I'm talking about Pfizer, and the CDC said today that its preference for Pfizer and Moderna vaccines also held for the booster shots, and that helped Pfizer. Shares close about 2.5% higher, 2.6%. Tim, no such luck for Moderna, though.
Yeah, that's a perfect segue. Let's talk about another vaccine maker. Shares of Moderna kind of bouncing all over the place today. It was really interesting because shares were up as much as 9% at the open after the company said a third dose of the COVID-19 vaccine increased antibody levels by 13 times. Shares, though, moving lower, finishing the day down by more than 6.2%. Shares of Oracle, we talked about this one on Friday because the deal that the Wall Street Journal broke late on Thursday to buy Cerner. Shares were down on Thursday after hours and then down Friday. Down again today after this deal was announced by the companies, 5.15% to the downside. Oracle buying medical record systems provider Cerner Corp for about $28.3 billion in an all-cash deal, the company's biggest acquisition ever. Shareholders of Oracle not necessarily cheering that news. Got my eyes on Nike. The company's going to report earnings after the bell, 2.7% to the downside today. We're going to have all eyes on supply chain comments, of course, about factory closures potentially in Vietnam, and then, of course, what's going on in China as well, Caroline.
Let's talk about supply chains when it comes to commodities right now, because I'm going to go cross-asset. GMM is your terminal gain of choice if you want to be looking at global macro movers. I'm looking at natural gas up more than 4 percentage points. Why is nat gas going up once again here in the US? It's the cold weather snap, but in Europe, it's about a supply chain issue. It's about worries of flows coming from Russia into Germany, as well as the colder weather. But elsewhere, commodities really taking a downdraft today. WTI crude off by more than 3.7%. $68 is where we end the day. That, as we saw, of course, the twin issues of Omicron and indeed the Build Back Better plan being just put on ice for the time being. What does that mean for global growth? What does that mean for oil demand? We see some of the metals take a hit as well. Zinc off by more than 1.5%. Moving on into the FX space, and that's why we see the commodity-related currencies take such a move lower. New Zealand dollar, Kiwi off by 0.5%. The Canadian dollar falling in sympathy with oil off by 0.4%. And we move instead into the likes of the Swiss franc up 0.2%, a haven trade, as we see once again the variant start to hit Europe in significant amounts. British pound off by 0.25% as we start to see this hospitalizations just tick up slightly, and 91,000 people affected by COVID in just one day alone.
Well, and you're certainly wondering if you see some of that, at least maybe a little bit of a safe haven trade, Caroline, in yields on the front end of the market. You're getting 2s and 5s catching a little bit of a bid, but really only 1 basis point. Go long around. That's where we're really starting to see some of that yield curve steepening. You're back up to, I guess, higher than what it was, but still 79 basis points here on the 2s, 10s, but really highlighting perhaps maybe some of the inflationary concerns that we still continue to have on the long end. Certainly not growth fears, at least for now. Micron certainly not seeing that, Caroline, as you take a look at some of their commentary about next quarter earnings. Very positive, still on track for, what are they saying, a record solid profitability on 2022. But it does really highlight some of the concerns that we've had about supply chain issues and maybe some of this variant.
Yeah, well, speaking of that, I think a lot of our audience, potentially a couple hours after they woke up this morning, woke up to the news that Davos was being postponed this year. It was supposed to happen in the mid part of January. I think perhaps not surprising that many people, given the Omicron variant's rampant spread. The question is, does it actually happen over the summer when it's being rescheduled to the second year in a row, Sonali, that it's canceled at least in January?
Yeah, January is a very messy January. We knew that JP Morgan healthcare conference is going virtual. There's another Milken plan just in following months after that. There's a hope that these things continue because the deal makers want a deal, right? They want to be able to get there.
But they can do that without conferences. They showed that in 2021 and in 2020, right?
I was telling Caroline, I have never seen a lead this big for Goldman Sachs when it comes to deal making. You know, a little bit of help there today from the Cerner deal that we saw with Oracle today.
Deals, they still get done, even though we're all worrying about the Omicron variant and perhaps not being able to jet across to Switzerland quite this January.
All right, but maybe this summer. Guys, we are going to have to leave it there. That is going to do it for our cross-platform coverage. Excuse me. There I go. That's going to do it. We'll see you tomorrow, though. Same time, same place on Bloomberg TV, Bloomberg Radio, and on YouTube.
You're listening to Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
It's Bloomberg Business Week. Tim Stenovic and Katie Greifeld live in the Bloomberg Interactive Brokers studio in New York. We are still awaiting earnings from Nike. That company expected to report any minute. Katie, we are expecting the company to, well, I know that we're expecting analysts to be looking at just what's going on in China and, of course, Vietnam as well. A read on the consumer around the world, too.
Absolutely. And I do want to quickly point out Micron. You also saw earnings from them after the bell. Sees 2Q revenue at $7.3 billion to $7.7 billion. The estimate was for about $7.3 billion. That is shooting shares higher, up 6.7% after hours, Tim.
Yeah, we're going to have much more on the earnings in just a few minutes. In the meantime, let's get a check of how the trading day ended up. For that, we headed to, well, actually a little check of world and national news. Excuse me. We have Nancy Lyons standing by in D.C. Hey, Nance.
Thanks, Tim. Despite a weekend pronouncement from Democratic Senator Joe Manchin that he cannot support the Build Back Better plan, White House Press Secretary Jen Psaki says President Biden is not giving up.
He's no stranger to legislative challenges, and we are going to continue to take steps, work like hell to get it done.
Psaki refused to reveal what plans the president may have moving forward on negotiations with Senator Manchin. Earlier today, Manchin did outline a roadmap for a package he could support, including one that would do more to lower drug prices and one that would extend the child tax credit, but with a work requirement. The Biden administration is out with tougher auto emission standards after environmentalists blasted its earlier proposal as too weak. Bloomberg's Nathan Hager has more from Washington.
The new EPA standards amount to fuel economy of 55 miles a gallon by model year 2026. They replace mandates that had been weakened under the Trump administration and will force automakers to cut another 22.6% of carbon dioxide emissions from their fleets. The move brings the Biden administration closer to its Paris Agreement goal of cutting overall emissions in half by the end of the decade. Passenger cars and trucks account for 17% of America's greenhouse gases. In Washington, I'm Nathan Hager, Bloomberg Radio.
SpaceX is preparing to launch its Dragon spacecraft from Kennedy Space Center in Florida. The launch, scheduled for early tomorrow morning, is a resupply mission to the International Space Station. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
Thanks so much for that update, Nancy Lyons, Tim Stenovic, and Katie Greifeld live in the Bloomberg Interactive Brokers studio in New York. Katie, let's talk a little bit about Cathie Wood. The conversation we would be having a year ago today about Cathie Wood's fund and ARK Investment Management and her flagship funds, including the ARK Innovation ETF, would certainly be different than the conversation that we're having this year.
Absolutely. I mean, it has been a brutal year, particularly brutal past few months for the ARK Innovation ETF. Remember, it was up, 150% last year? Just absolutely crushed it. Then you look today, down almost 24%, Tim. So a really brutal time for those sort of speculative tech names that she loves.
Well, as our own Claire Ballantyne writes, when Cathie Wood speaks, investors listen. But over the weekend, many weren't so sure that they were picking up what she was putting down. The famed active manager sparked some skepticism among investment professionals with a market commentary piece on Friday on her website, where she said that her ARK Innovation ETF, quote, could deliver a 40% compound annual growth rate of return during the next 5 years. That's a bold claim for the tail end of 2021, which, as we talked about, Katie, it's proven to be her worst year since she started her ARK Investment Management. Plus, she's only been one other time in ARK's 5-year projection that has been that high, she noted, at the end of 2018.
And it seems like that comment in particular, because I was watching this play out on Twitter all weekend, that, you know, the ARK Innovation ETF could deliver a 40% compound annual rate over the next 5 years. That seemed to spark a lot of ire. In particular, this article has a tweet from Twitter user Bill Mulvihill questioning, how is that legal? Are you even allowed to make a claim like that if you do run money for other people?
Well, you know, one thing that she has talked about is this 5-year investment horizon.
Mm-hmm.
And this is nothing new for her.
Mm-hmm.
Talking about how if you are investing in ARK and investing in her, you're looking at the 5-year. And her goal, I believe, it's 15% per year over 5 years.
Mm-hmm. And she sticks to her guns when she makes those calls. Tesla, Bitcoin, she is stuck by both those bets, even when it looked pretty painful.
All right. Well, this is Bloomberg Business Week. In just a few minutes, we're talking Nike earnings. You're listening to Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
We're hearing from Nike after the bell. The company reported revenue for the second quarter of $11.36 billion. That was above estimates. And if you look at the stock in late trading right now, shares are higher by about 2.5%. Generally speaking, the equity market was on the back foot today. A lot of concerns here, not the least of which the future of President Biden's economic agenda. It's in doubt now after Senator Manchin basically rejected the current Build Back Better plan. This package is worth roughly $2 trillion. And Manchin's position essentially precipitated a move on the part of economists at Goldman Sachs to reduce their forecast for U.S. economic growth in the year ahead. If there is a bright spot for the equity trade today, it's that the S&P bounced off of that 100-day moving average. Yes, we were lower, but off the session lows. S&P today down about 1.2%. The Dow weaker by more than 1.2%, and the Nasdaq Composite also off about a little more than 1.2%. But the small cap space was hard hit, with the Russell 2000 today dropping about 1.6%. Trading volume light. We have a holiday shortened week. We also had a big drop in crude oil today, with WTI falling more than 3.7%. We closed New York trading at 68.23. And in the bond market, 10-year Treasury last quoted at a yield of 1.42%. I'm Doug Krisner, and that is your Bloomberg Business Flash.
Thank you so much for that update, Doug Krisner. Well, you heard it from Doug. Nike out with earnings, and shares and after hours are surging higher by 4.2% right now. Second quarter revenue beating estimates, coming in at $11.36 billion. Estimates were for $11.26 billion. On the bottom line, though, a handy beat. Nike EPS coming in at 83 cents. Estimates were for 63 cents. Gross margin also beating expectations. China revenue a little light, though. Estimates were for $2.14 billion. Nike reporting China revenue at $1.84 billion. Let's get into it with Poonam Goyal, senior analyst for e-commerce, athleisure, off-price retail for Bloomberg Intelligence. Poonam joins us on the phone from New Jersey. Poonam, I know that you've only had 4 minutes and 40 seconds to look at these earnings, but what sticks out to you?
The inventory levels. The inventory is still light going into December for them, which is their fiscal third quarter, up only 7%. Just, shows us that the supply chain crunch is still here. It's not gone away, and it's not getting really that much better anytime soon.
So given that, inventory levels didn't increase to maybe the extent that had been hoped, I mean, does it make sense to see the stock up, 3% after hours? Are we going to be having a different conversation at the market open tomorrow?
I think, look, there was a silver lining here. Their gross margin increased 280 basis points. That goes to show the strength of being able to sell at full price given lower inventory levels. And we've seen that across all of retail. They did beat on the top line. So encouraging given the headwinds in place. Their results were definitely, better than expected. But if anyone's going to come out and say that they're not going to have supply constraints going into their fiscal third quarter in calendar 2022, that's probably not the expectation that anyone should have going into this earnings call.
Hey, what do you make, Poonam, of the China revenue for Greater China, I should say, coming in at $1.84 billion, missing estimates of $2.14 billion? How should we be reading into that miss?
I think China's been weak, not just for Nike, but for many other retailers that have reported. So I wouldn't read it as a Nike-specific problem at all. Part of it, they mentioned it was due to the inventory constraints that they had. But remember, there was also flooding in China, right? And they have that zero-tolerance COVID policy. So there's a lot going on in that region that's out of Nike's control. And we do still see China and APAC as a longer-term solid opportunity for them. It's just near-term. There are some headwinds that they just can't control.
And Poonam, I mean, like you just said, this isn't a Nike-specific problem. This is something that, a lot of sportswear brands are dealing with when it comes to China. Which are the best positioned, though, to manage through this?
I guess the ones with the least China exposure, right? So I think Lululemon has done a fantastic job given their greater exposure to outside of China. On this front, other retailers, that aren't as exposed to APAC will hold up better, because North America is thriving. I mean, we saw that in even Nike's results, right? The North American business was very, very well received despite the supply chain hiccups that we're seeing.
Big picture, Nike trying to move more so in the direction of being direct to consumer. What are the questions that analysts are going to be asking around that shift today? And how do they do that without alienating really important partners?
Yeah, I think, look, everyone's moving to the DTC model. Nike wants to have 50% of its sales come from DTC or direct to consumer. And that's huge, right, for retail right now. But that is where the world is moving. That is where the customer is. And for brands to be able to own their brands and their marketing push and funnel it through their own channels is what's happening across the board. So Nike isn't the only one doing this. It's everyone. And we think they'll work with the key wholesalers that they work with. If you're not selling Nike well, then you're probably not going to have Nike for too long to sell.
And Poonam, given that we are talking on December 20th, I'd love to get your thoughts on 2022 because you had an interesting note out last week. Nike leads Adidas as athleisure strength may extend in 2022, but you do write that Nike may maintain its lead, but Adidas is narrowing the gap. Walk us through that.
Yeah, so, we looked at market share data there, and basically Nike holds the #1 spot for athleisure across the globe, and especially in North America. We do see others, though, climbing because the athleisure market is growing as a whole, and Adidas is investing more aggressively in digital and in North America. So that gap is narrowing, but it's not narrowing to a point where Adidas could overtake Nike by any stretch anytime soon.
Factory closures. How concerned should investors be about more factory closures affecting the supply chain for Nike?
I think we saw the brunt of it already with the Vietnam closures. Now, look, if Omicron or, there's another virus that comes out, very concerned. China has a zero COVID policy, and much of the manufacturing is done in China and Vietnam. So there's still a concern out there, but nothing that would tell us that we're going back to the August timeframe when Vietnam was largely shut down and they couldn't produce shoes. There just wasn't enough production to meet demand. I think we're getting better from that point of view, but we're nowhere near where we were prior to the start of this year.
And Poonam, I would love to hear what you will be keeping an ear out for on this call.
Yeah, I'm really looking to hear about in-transit inventories. They said part of North America's strength in the 2Q was driven by in-transit inventory that really helped sales there. So how much of the in-transit inventory have they gotten to help fuel December demand? Because we are 5 days from Christmas.
Oh, but who's counting?
Right. And how much is going to be left over? What are they going to do with that? Is that all inventory that's going to have to be discounted? Or is that inventory that's pretty stable in nature where they can continue to sell it at full price going into January and thereafter?
Yeah, discounts. That's the question. If consumers stick around and be patient until January, are they actually going to have the inventory, and will the companies be discounting it? That certainly remains to be seen. Poonam Goyal is senior analyst for e-commerce, athleisure, off-price retail for Bloomberg Intelligence. She's breaking down the Nike earnings, which we just got. Joining us on the phone from New Jersey. You're listening to Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 1061 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
It's Bloomberg Business Week. Tim Stenovic and Katie Greifeld live in the Bloomberg Interactive Brokers Studio in New York. Katie, does it feel like each and every day you open up the Bloomberg terminal and read about another crypto company getting a few $100 million in funding?
It's pretty crazy. I mean, even with this swoon that we've seen in the price of Bitcoin, it feels like investment in the space has not slowed down at all.
Yeah, well, crypto has lured more money in 2021 than all previous years combined. We're going to talk about venture capital, not just in crypto, but in tech as well, in just a few minutes. In the meantime, a check of how that trading day ended up. Here's Doug Krisner.
Hey, Tim, let's begin with Nike. We heard from the company after the bell, and revenue for Q2 that was above forecast. The stock right now in late trading is higher by about 2.7%. Generally speaking, in terms of today's session, the equity market was on the ropes. A couple of concerning developments. One includes the future of the president's economic agenda. It's in doubt now after Senator Manchin rejected the Build Back Better plan. It's got a price tag worth roughly $2 trillion, and it caused this retreat on the part of Manchin, caused economists at Goldman Sachs to reduce their forecast for U.S. economic growth next year. And we also have to consider the effect of the virus, right? Europe's biggest countries are now introducing some more restrictions. Switzerland, one example, the World Economic Forum postponing its annual meeting in Davos. It had been slated for January. Today, the Dow Industrial Average gives back about 1.2%, S&P 500 weaker by nearly 1.2%, the NASDAQ Composite falling about 1.2% on the day. Little movement in the bond market. 10-year Treasury last quoted in New York at a yield of 1.42%. I'm Doug Krisner. That is your Bloomberg Business Flash.
Thank you so much for that update, Doug Krisner. Well, during the break, Katie and I talked about the massive amount of money that has gone into venture capital firms from venture capital firms this year into crypto. More money in 2021 has gone to crypto companies than in all previous years combined. But it's also been a banner year for venture capital investment. According to Crunchbase, more than $54 billion went into more than 2,000 companies around the world as of October of 2021. This marks the fourth highest funding month in 2020. That was just for that month. Year-over-year growth of 84% for just the month of October. So we'll have to wait till the end of the year to get the stats for all of 2021, but it's shaping up to be another huge year for venture capital. Let's get into it with Lonnie Jaffe, Managing Director at Insight Partners. Insight Partners is a global software investor. It has more than $30 billion in capital commitments through a series of funds. Lonnie, how are you?
Doing well. Thanks for having me on the show, Tim.
How would you characterize where we are with venture capital as we get to the end of 2021?
So when COVID first hit, a lot of people were experiencing incredible levels of hardship and change, confusion. And we originally thought that many of our portfolio companies were going to have to tighten their belts, reduce expenses, conserve cash. We were all bracing for significant declines in top-line revenue, but that really hasn't been the way things played out as well at all. Like, the companies were incredibly resilient. Many even experienced extremely high levels of growth. And as a firm, we ended up deploying at Insight Partners more capital in 2021 than we did in 2020, and then more in 2020 than in 2019. We made over 100 investments this year. So it's been somewhat surprising.
Wow. Well, let's talk about some of those investments. I mean, where in this really surprisingly strong year for corporate fundamentals, like you just described, did you find value?
So we've been investing a lot in the applied machine learning and artificial intelligence space. There have been some interesting breakthroughs, like you saw things like AlphaGo, which could discover new game strategies and have breakthroughs in drug discovery and driving assistance with cars, and these large models like GPT-3 that can exhibit behaviors that are very much like genuine creativity, like drawing images and writing text that is almost human-like in its originality. And so, we invested in a company recently, actually just announced today, that called Overjet, which is using machine learning for dental AI technology. So the CEO, Warda, and her team, they built this powerful technology that encodes dentist-level understanding of x-rays into AI software that allows you to diagnose issues with teeth and gums. And we've done a few of those. So we did another one, ScreenPoint Medical, which uses computer vision AI on mammograms for fighting breast cancer.
Lonnie, I just want to know for our listeners, Insight Partners has invested in companies like Shopify, Alteryx, Tenable, HelloFresh, Yext, DocuSign, Trivago, Tumblr, Udemy, Monday.com, Calm. The list certainly goes on. I'm wondering, though, how you're thinking about 2022. If you think about the different types of companies you've invested in and Insight Partners have invested in over the years, what is the big theme as you go into 2022?
Well, we're seeing a couple of, the broader theme is software, even though, software itself is now, in many ways, taking over the whole macroeconomic system. If you look at the top 7 largest companies in the world, they're all essentially software company DNA at their core. I think, so we're going to be leaning into that general theme. There's a couple of, besides machine learning, we're doing a lot in cybersecurity. 2021 was a pretty bad year when it came to cyber attacks. There was the ransomware attack of the insurance company CNA Financial, where they had to pay a $40 million ransom, Colonial Pipeline, the chemical distributor Brenntag. I think it's an easy prediction to say that 2022 is going to be a lot worse across both cybersecurity and ransomware. And so we need as much innovation in the space as we can get, right? Like the deep collaboration between high-tech companies and government, but also a lot of innovation. So we've been investing pretty heavily. We just invested in a company called Laminar, for example, which detects the inadvertent leakage of sensitive data from applications. So that's been a big focus. And I also think companies will need a little bit more coherence to their cybersecurity offerings. So I think there's going to be consolidation. Like we have a portfolio company, Aqua Security, which is one of the leaders in developer-centric security software, and they've been pretty active with M&A. So they acquire really interesting high-growth startups, and it's not really an exit for them because they more join forces with Aqua, but they're able to fuse with the broader platform, and it makes things easier for the customers because they can have a nicely integrated end-to-end solution.
And it just feels like this year there's been so much money looking for a home. Tell us about what the competitive landscape looks like for investing in deals. And we have just about a minute left.
So the way we think about it is there's kind of 2 components to scale up returns, right? There's the growth and then the multiple. And as more competition has come into the market, you have seen multiples overall go up. Although in the public markets, they've come down a bit recently. So you just need to build in some cushion for significant multiple contraction. But over long-term time horizons, the returns from investing in scale-ups are actually dominated by the other component, the pace and duration of growth, right? If you have a company grow for 50% a year for 10 years, it's 50 times larger. But if it grows for 50% a year for 20 years, it's like 3,000 times larger, right? So at Insight Partners, we've just been really focused on finding companies that have sustainable business models where you have things like network effects and data moats that make the company good over long time scales.
Lonnie, sit tight because we're going to do some news and then we're going to come back with you and we're going to talk about some of these companies and some of these sectors and more trends to watch for 2022 and beyond. That's Lonnie Jaffe, Managing Director at Insight Partners. The venture capital firm has $30 billion in capital commitments through a series of funds, and it's invested in some of the best-known names that you've certainly heard of, including Shopify, Qualtrics, and more. In the meantime, a check of the latest world and national news. Nancy Lyons standing by in our 99.1 newsroom in D.C. Hey, Nance.
Thanks, Tim. Jury deliberations are underway in the trial of the former Minnesota police officer Kim Potter, who's accused of killing black motorist Dante Wright. Minnesota Assistant Attorney General Aaron Eldridge says Potter was negligent when she fired her gun instead of a taser.
The defense will tell you that Dante Wright is somehow to blame in causing his own death. But make no mistake, we're here because of the defendant's actions, not Dante Wright's.
Potter is charged with first-degree and second-degree manslaughter in Wright's death. Her attorneys say she made an honest mistake. Senator Joe Manchin has thrown the White House and Democratic leaders a weekend curveball by publicly rejecting the Build Back Better plan after weeks of negotiating. As Bloomberg's Irv Chapman reports, some are worried about what it could do to the economy.
Economists have started to trim their growth forecasts, in particular because one element of government spending has been allowed to expire. Julia Coronado, president of Macro Policy Perspectives, explained in a Bloomberg interview.
The main near-term impact
impact is the loss of the child tax credit. So some 35 million households receiving several $100s a month. And a lot of these are working class households that tend to spend the money. So there will be an immediate impact.
Coronado said the economy remains strong, though a hit to travel and socializing from Omicron could also have a near-term impact. In Washington, Irv Chapman, Bloomberg Radio.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
Thank you so much for that update, Nancy Lyons, Tim Stenevec, and Katie Greifeld, live in the Bloomberg Interactive Brokers studio in New York. Katie, you might have heard about the interference associated with 5G versus airlines. We're learning more about what airlines are warning about specifically and some of the complications from that. So widespread flight delays and snowstorms, low visibility could occur once new 5G wireless service rolls out in early January. That's at least according to airline executives and aviation officials who are warning with increasing alarm.
Yeah, and Tim, like you said, the clock is ticking. So the service starts on January 5th. So this issue really coming to a head. You have White House officials, regulators, industry groups struggling. AT&T and Verizon have both offered power reductions, but the aviation industry, it says those cuts are inadequate at this point.
Well, think about what's been happening to the airline industry over the last close to 2 years. The prospect of flight disruptions come as airlines struggle to recover from the coronavirus pandemic that led to billions of dollars in losses. Carriers have also been dealing with staff shortages and thousands of unruly passenger episodes this year. And the industry is concerned that the 5G clash will cost as much as $2.1 billion in flight disruptions. That's according to the trade group Airlines for America.
Yeah, and like you laid out, I mean, it's been a really difficult 2 years for the airline industry. We'll see how this one shakes out. Bloomberg News reporting, according to people familiar with the matter, that Transportation Secretary and the Federal Communications Commission Chairwoman met with officials from the White House's National Economic Council on Wednesday. But again, the time is running out given that it is December 20th.
Well, here's what's at issue. So the 5G signals that we're talking about will operate in airwaves near those used by radar altimeters, which determine altitude by bouncing radio waves off the ground. The aviation industry says that tests show that 5G can interfere with the altimeters, posing hazards, especially during bad weather landings. Mobile providers dispute that outcome, saying that 5G signals are sufficiently separated from the frequencies used by altimeters and are set to operate at safe levels. You're listening to Bloomberg Radio. This is Bloomberg Business Week. More in just a couple of minutes.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
A couple of key reports after the bell. We begin with Nike. The company reported second quarter revenue above estimates. It seems as though Nike was able to overcome some global supply chain issues to enter the crucial holiday season with very strong inventory levels. Nike shares right now in late trading higher by around 2.5%. We also heard from Micron Technology. Stock is up in late trading after the company gave an upbeat forecast for the current quarter, helped in large part by demand for chips in networking, data centers, and even in vehicles. And Micron shares right now up by more than 6.5%. All of this comes after a day of weakness for the equity market. A couple of concerning developments. One, President Biden's economic agenda. It's now in doubt since Senator Manchin rejected the Build Back Better program in its current plan. And also worrisome, the spike that we have seen in COVID cases, particularly in Europe, where a number of countries are introducing some more restrictions. So today we had the Dow dropping 1.2%, S&P 500 also weaker by nearly 1.2%, similar decline for the NASDAQ composite. Crude oil falling 3.7% in the regular session, WTI settling 68.23. And in the bond market, 10-year Treasury last quoted at a yield of 1.42%. I'm Doug Krisner. That is your Bloomberg Business Flash.
Thank you so much for that update, Doug Krisner. Tim Stanovic and Katie Greifeld live in the Bloomberg Interactive Brokers studio in New York. Let's get right back to Lonnie Jaffe, Managing Director at Insight Partners. It's a venture capital firm that's raised more than $30 billion in capital commitments through a series of funds. Their portfolio includes some big names that, of course, you've heard about, including Shopify, Qualtrics, Alteryx, Yext, HelloFresh, Wix, Twitter, small company I use each and every day, DocuSign, too. Hey, Lonnie, I want to talk, though, with you about AI, and I want to think a bit less about the exits that you've had in recent years and more about the big themes and the big trends that you expect to see. Just a really basic question about AI. How should we think about the definition of AI right now?
So these are software systems that make predictions based on data. So the data comes in and software comes out in the form of predictions. And it sounds simple, but it really has applicability across pretty much every industry. And you're seeing things like Google search or Amazon recommendation engines. They can sort of reshape entire industries around these core learning systems that get better as more data comes in. And in many cases, they don't just make amazing products, they can make amazing businesses because the business can get better as more people use the product. So it has kind of a natural scale effect.
And so what does your due diligence look like when you're evaluating AI companies potentially to invest in? Because it is, a very new industry.
That's a great question, Katie. So the process involves many of the normal things that you would look for, like lots of net new ARR being added and high gross margins and high gross retention rates and lots of upsell. But then it has this additional component where you want to see if the system can continue to absorb incremental data productively. So it's great to have an idea that if you had more data, you would have a nice advantage over competition. But, for example, we invested in a company called Tractable, which uses AI image recognition to figure out how much it'll cost to repair a damaged vehicle based on a photo. And so as they get more photos that come in and they make more estimates, the system continues to learn, and everyone wants to use the system that's getting better the most quickly. And you can diligence that by the time we're investing in the companies. It doesn't guarantee that will persist any more than historical revenue growth guarantees that future revenue growth will be high, but at least it gives you a really strong signal of momentum.
And Lonnie, I gotta ask you about crypto. There was a great article from Crystal Kim out on Bloomberg over the weekend that crypto raised about $30 billion poured into crypto from venture capital funds. That was more than quadruple the previous high of around $8 billion in 2018, and really more than all the previous years combined. Would love to hear how you and Insight Partners in general think about the crypto space, because it is so vast and it is so new.
Yeah, I mean, we've been investing in the sort of technology companies that are powering a lot of the new platforms that are coming out. So, for example, we invested in Candy Digital, which is Major League Baseball's official NFT partner. So it makes things like baseball cards that are online. And TradingView, which is the world's leading charting and social network for traders of crypto and stocks and commodities. which just passed over 1 million paid subscribers. And there's a really cool technology that allows you to recover private keys, which is otherwise a very intractable problem in the crypto space. So, our view of it is that it's a marathon, not a sprint.
Give us an idea of how you're thinking about Web3 at Insight Partners. Are you thinking that this is something that you will invest almost exclusively in the coming years? Or is it still something that's, I don't want to say fringe, but tertiary?
So the way I think about it is similar to open source software, right? So you have some interesting open source projects that have become unbelievably successful, like Linux or Kubernetes, which is another important infrastructure product. And it's basically a group of developers who, kind of on a volunteer basis, although some of them are employed by companies, will just contribute to the software. But most of the stuff that you need to do in technology today needs to be a service. It can't just be software. Somebody needs to run the service. And so a lot of these crypto business models are ways to not only entice people to do the open source software development, but also to run something like a distributed file system that you could keep data stored in and things like that. So that's the lens through which we're focusing the investments. And we also are, looking for things that are getting real user adoption. And it's still very early in that respect, right? So there's very few systems that are, other than trading platforms and things like that, that are getting like enormous amounts of user traction.
And I mean, just talking about Web3 reminds me of what we were talking about in the previous block, cyber attacks, how you saw so many of them in 2020. It was really one of these stories of 2020. And the whole pitch for Web3 is that it's decentralized, that, you're taking power away from just a few big corporations that own the web. Who knows? Maybe that'll lead to more cyber attacks. But just on the topic of cybersecurity, it seems like, Lonnie, that it's almost inevitable that we're going to see more of that come next year.
Yeah, that's right. I mean, I think if you look at some of the trends around the pandemic that have been accelerated for teaching and instruction. So in those kinds of scenarios where people are all going home with their laptops and punching holes in their corporate systems or connecting to educational environments, the surface area, and I think this is true, just like this was already happening, but it's just been accelerated by the pandemic and people were not prepared for it. The surface area of the attacks has gotten so much broader. And so the level of technology so as a cybersecurity investor, this is interesting because it creates huge market opportunities for some of the companies. But it's a real challenge. I mean, our companies are also dealing with cyber defense continuously, and so we've been investing ready to. Yeah, well, we are seeing some real innovation on the attack side too. We even saw a machine learning based attacker show up the other day that sort of is learning from systems. But the innovation in the cyberspace is fantastic. So I'm betting on the good guys here.
Hey, Lonnie Jaffe, really great to have you on the program. Really appreciate you taking the time and sharing what you're thinking about in 2022 and beyond. That's Lonnie Jaffe, Managing Director at Insight Partners. The venture capital firm has raised more than $30 billion in capital commitments through a series of funds. That is going to do it for our program this afternoon. Katie Greifeld, what a great show.
It was a great show. I'll be here tomorrow. You won't.
I won't be here tomorrow, but I will be back on Thursday. Will you be here?
I won't be here.
Okay. That's going to do it for Bloomberg Business Week. Coming up next, it's Sound On.